Welcome back to the European Market Open. A minute to go until the start of cash equities trading for this Tuesday morning. Here are your headlines. The US energy crisis deepens. Prices soar to record levels, with at least 5 million people losing power amid the deep freeze. Turning iron ore into gold, BHP rewards investors with a record payout as commodities trader Glencore reinstates its dividend. And the final lockdown. UK Prime Minister Boris Johnson is gradually drawing up plans to ease pandemic restrictions, wanting this lockdown to be the last. Let's have a look at where the futures are then right now. We said as we went into this hour of programming that the futures picture was fairly flat, and that continues to be the case. Either side of the flat line, really, perhaps a little bit less expectation over in Germany. Elsewhere, perhaps a little more. Watching with interest this earnings season, in particular today, the commodities dimension to it. A number of companies having the confidence to come back to the market and pay out more money to shareholders is in itself a fairly interesting phenomenon. So we're just getting these European equity markets underway this morning. The FTSE 100 then looks to be fairly flat. You can also see, the trend in government bond markets has been interesting recently, and in fact we seem to have turned a corner there. The trade in the last couple of days has been to sell government debt and certainly buying equities at the same time, and that seems to be different today. Today we seem to be buying government debt and equities perhaps pausing. Not on the London market though. The FTSE 100 is up by 0.4%. The French CAC 40 also moves to the upside. We often wait for the Xetra DAX to get into its stride, and we do so today. That could add a little bit of downside drag, if you like, to these markets. But the Stock 600 early out of the gates up by 0.2%. So European equity markets opening broadly flat to positive. 10-year Treasury yields jump above 1.24%, the highest in almost a year. That's amid this week's global debt sell-off. And Brent crude edging higher today after closing at its highest in almost 13 months. Let's get into a markets conversation now then with Tushka Maharaj, JP Morgan Asset Management Global Multi-Asset Strategist. Tushka, good to speak to you. So we see European equity markets making some tentative moves to the upside this morning. That comes in the context of ever higher levels for global equity markets, and we've seen some records being taken out in various geographies. What kind of appetite do you have for European equities at this point, given how far we've come?
Morning, Anna, and thanks for having me on. European equities are in an interesting place at the moment. We like broad-based equity exposure, so we are positive on equity markets relative to bonds. And I'd say within that, we like exposure to cyclical markets that give you a leverage to the reopening play that we're expecting in the second half. Basically, we're expecting the reopening to lead to above-trend growth for this year. And actually, Europe's well placed to benefit from that reopening. I know there have been delays with the rollout of vaccines domestically in Europe, but we see that as a delay rather than a derailment of reopening in European markets. The other sort of benefits for Europe at the moment are, we talked about political risk premia. especially in Italy, and now we're seeing that recede somewhat with President Draghi taking over there. And actually, when we think about growth data in the next that we're getting out later today, what we've learned is actually European economies are actually dealing better with the lockdowns than they did in the previous phases of lockdown. When we look at industrial production, we look at revision ratios for economic data, as well as earnings. Earnings have held up very well in the last quarter. So Europe is a preferred market because of its cyclical exposure, but also from a domestic perspective, we're seeing a strong policy support as well, whether that's fiscal as well as monetary.
And indeed, and there's a lot to talk about when it comes to the earnings story around commodities, and we'll come back to that in just a moment, Thushka. I wanted to, you mentioned there the removal of tail risk when it comes to Italy. Do you still see that with further to give? Has that move already taken place in markets, or could that keep playing out?
So we see it as a near-term removal of risks in Italy. I mean, it's hard to say this is necessarily a long-term change, but I would say a few things that support the rally for, let's say, BTPs or credit risk premia contracting or tightening in Europe. One, the ECB's bond purchases. When you think about the net issuance in markets like Italy, it's a massive negative, over 100 billion of net issuance because of the ECB support. You add in the European Recovery Fund, and now with Draghi at the leadership, that actually means the usage of that could be more effective than we had expected in the past. So we still expect modest spread tightening. If you're thinking about BTP spreads as your measure of political risk premia, we're still expecting a modest spread tightening there. We could actually make new all-time tights given the central bank support and low overall bond yields. But yes, a lot of it's happened already. It's more of a carry position right now rather than a major capital appreciation one.
Thushka, where do you stand on UK assets at this point? The FTSE 100 outperforming this morning. We've had earnings reports out from a sector that is pretty heavily weighted in London, and that's around commodities. We'll get further to the commodities conversation because there's a lot to talk about a little bit later on in this half hour. But in terms of UK assets right now, what is guiding your expectations for the FTSE, for the 250, the global narrative versus the domestic?
Yeah, in terms of the equity markets, we had a preference for other global markets, whether that was the US, whether that was the euro area or emerging markets in general, relative to the UK for quite a long time, and very recently have closed that position where we had the UK as the least preferred market, mostly because, yes, it's underperformed quite significantly over the last 12 months. We do see value, as you mentioned, in commodity markets, and actually the UK would benefit very strongly if there was a sustained rotation to value sectors. So for the moment, we are neutral on the UK equity market. So this is the high-level FTSE 100. We do see reasons for a preference for the domestic economy relative to the FTSE 100, where most of your earnings are in from foreign companies. But essentially, for UK assets, we see sterling having appreciated quite significantly. That is now catching our focus. So actually, when we think about the medium-term outlook for the UK economy, we see a lot more uncertainty post-Brexit. So we are looking at sterling more closely. For the FTSE or for the UK equity market, more neutral relative to its peers. But what we actually do notice is that the UK would benefit very strongly if a value rotation were to take hold. When you think about energy, when you think about banks, when you think about pricing for higher inflation outcomes, the UK would be a strong beneficiary in that outcome.
Yes, and let me pick up on that value rotation, because we see that one of the best performing stocks in London today is HSBC. Standard Chartered also moves higher, and both of these have done well through the Asian session. The reflation trade being suggested as the reason for that. Some say, though, that there's risk, certainly in the European banking story, there's risk of bankruptcies, of corporate insolvency, and therefore they prefer to invest around government spending rather than parts of the recovery story that could be overly reliant on the consumer and those consumer-facing businesses? How do you weigh up where you want to be involved in banking at this point?
Yes, I think that is a fundamental question, Anna. For us, when we're thinking about financials and we're thinking about banks in particular, it's very hard for us to have a high conviction positive view when bond yields are low and yield curves are, yes, they're steepening, but from a very low base, and absolute levels of rates are lower. What I would say, the positives, though, are the provisioning we've had for loan losses has actually been higher than expected, and actually there's reserves there that can be reutilized and put back to work. The second reason is we've seen central banks, so for example in the ECB's case, they are looking to reinstate or at least allow for more dividends to be paid out from banks. So for us, if we were to look at the banking sector in more detail in Europe, it would be a valuation case, but also some tailwinds as the economy reopens, because of the conservative nature of these loan loss provisions. I'm not saying that we are overly optimistic on that front, but actually it would be a tailwind if that turns out to be higher than expected.
Thushka, thank you very much for your time so far. Thushka Maharaj, JP Morgan Asset Management, Global Multi-Asset Strategist. She stays with us. Really good to get her thoughts on some of those sectors that are moving this morning, the banking sector amongst them. We must also save some time to talk about commodities. Coming up on the program, the deep freeze stateside pushes crude higher as the risk rally in other assets heats up. The latest sign the reflation trade is alive and well. We'll talk about that. The narrow story around Texas and the freezing temperatures there, and the broader story around reflation. This is Bloomberg. Welcome back to the European Market Open. 12 minutes into our European trading session for this Tuesday morning, and even the DAX in positive territory. So contrary to futures, which had suggested perhaps a little bit of downside. The FTSE 100 flying high, the banking sector and the mining space both move a little higher this morning. We'll get further into the conversation about commodities in just a few minutes. Let's get a Bloomberg Business Flash. Here's Laura Wright.
Thanks, Anna. And on commodities, BHP is boosting its outlook for the global economy as the rollout of COVID vaccines gathers pace. It's backing optimism by rewarding investors with a record $5.1 billion payout, fueling expectations for a new commodities supercycle. Profits rose 16% in the first half on surging iron ore prices. Glencore has reinstated its dividend on the back of record trading profits. The world's biggest commodities trader benefited from volatile oil swings in the first half of 2020 and soaring copper prices. It's the final report under the leadership of billionaire CEO Ivan Glasenberg. He's handing over the reins to coal boss Gary Nagle. Lufthansa is in talks with plane makers about switching to smaller jets. It wants to swap some of its orders for the larger craft to small, long-distance models. It's having to adapt its fleet to an enduring slump in intercontinental travel as the pandemic continues to hit demand. That's your Bloomberg Business Flash. Anna.
Laura, thank you. Laura Wright here in London. So Brent crude edging higher today after closing at its highest in almost 13 months. A deepening energy crisis in the US is disrupting production, forcing the shutdown of some of the nation's biggest refineries and leaving millions without power. Meanwhile, strong earnings from commodities giants Glencore and BHP are fueling expectations for a new supercycle.
I think there's been a very prolonged period of underinvestment across the commodity complex, not just in energy, and that will have an impact on supply availability for some period to come. And as we move through the energy transition, rightly or wrongly, we will continue to need oil as a major supply of energy.
Fiona Boll there with her thoughts on the oil market and where it goes from here. We spoke to her last hour. Thushka Maharaj, JP Morgan Asset Management Global Multi-Asset Strategist, is still with us. Thushka, your thoughts on the energy space at this point, and maybe I'll focus in on oil prices and where we see oil at this juncture. Clearly, the most immediate concern is getting power back to those houses that don't have it in parts of America. But $60 a barrel thereabouts, we're flirting with that level once again on WTI. Is this just a short-term bump up in oil prices, or do you see something? I mean, it's been a long, slow drag upwards from negative back in April of last year. Do you see that upward move in oil continuing?
Yes, Anna. We do see a modest rise from here for oil prices in particular. I think you mentioned the supply constraints there being one factor. Yes, that's a near-term factor, and we think that does boost the prices in the short term. But when we think about it from a top-down sort of macroeconomic perspective, our views on the global economy, our above-trend growth estimates, and our expectations that the second half of this year will see a strong reopening are all supportive for the demand side as well, for commodity prices. So a few factors that are supporting crude, both supply and demand. When we think about the shale reaction function, actually what's been surprising to us is up to now we haven't seen a big upturn in that production. So even though prices are moving higher, without seeing that rebalancing or balancing force coming out from an increased shale production, it is possible to see modestly higher. I wouldn't say an acceleration from here, but modestly higher oil prices.
Yeah, there does seem to be some supply discipline, doesn't there, in that region. Thushka, in terms of the earnings story we've seen from commodities businesses, the theme this morning seems to certainly be having the confidence and having produced the results to enable increased payout to shareholders. Further distribution from that sector, is that something you're banking on?
We are positioned pro-cyclically, and energy definitely is part of that mix. We are not banking on a reassertion of dividends, but I guess the question you're asking in a way is this the start of a super cycle? Is this something that we're going to see in the long term? I'd say we are more positive on the business cycle arguments for higher oil prices. It's harder to see the ingredients for a major super cycle, especially in crude oil commodities. But essentially, our view on fiscal stimulus spending, our views on the China stimulus that we've had, all of these are very supportive for those industrial parts of the complex. So when you think about copper, iron and steel production, for example, we do see these as being beneficiaries. The secular trend for in our case is actually the long-term view is actually around the greening and decarbonization theme, which actually does support these industrial sectors a bit more.
Yeah, so there's some interesting different themes there. In terms of investing in a super cycle, if you do see, you mentioned your hesitancy about calling it that, a bull market, maybe not a super cycle, but do you, if you think that we are in a super cycle, would you be tempted to play it directly through commodities or the FX linked to commodities? What's the best way to get involved with this?
I would say yes. We are looking more at indirect ways, whether that's, as you say, currencies exposed to these commodity producing economies, whether that's equity markets. As you mentioned today, the earnings profiles have been very strong and actually surprising to the top side. So there are multiple ways we can play this theme if we thought this was the start of a super cycle. For now, I would say our pro-cyclical a positive view on risk markets encapsulates that positive view on energy markets today.
All of this talk of cyclical recovery and recovery in commodity prices, Thushka, we've certainly seen Treasury markets, we've seen sovereign bond markets moving on this theme of late. Treasury yields on the US 10-year 1.23% this morning. I talked to a guest in the last hour who said he thinks that the equity bull market can withstand 1.5%, and depending on growth conditions, could even withstand 2.5% on US Treasury yields. What's your expectation of the link between the two?
Yeah, we are definitely positive on equities relative to bond markets. I think that's an easy statement to make. But what I would say is that we are expecting bond yields to remain very capped. And if they are to rise, it would be very gradual. It will be controlled by central banks. We heard this from Chairman Powell last week, how far away we are from their measures of success, both in terms of inflation and employment. So even though bond yields can rise, when we look at what's priced into the forwards 12 months ahead, 1.5%, that looks reasonable to us by the end of this year, but we expect that to be extremely gradual. I'd say our highest conviction view at the moment is that any rise in bond yields will come alongside an improving economic outlook and will not be there to derail the risk rally. So we're not expecting a huge tantrum in bond space at this stage. So when you say, can the markets withstand higher bond yields? I'd say yes, as long as it's coming alongside that improving growth outlook. 1.5% already looks high to us by year end.
Okay. Thushka, thank you very much. Really good to speak to you. Thushka Maharaj, JP Morgan Asset Management Global Multi-Asset Strategist. Thushka will be continuing her conversation with us on Bloomberg Radio at 9 a.m. UK time. Coming up on the programme, the energy crisis that crippled the Texan power system and sent prices soaring to record levels is deepening. With the state increasingly relying on green, we take a look at the energy transition next. This is Bloomberg. European market open, 23 minutes into the European trading session. The London market being lifted by the banking sector and the mining sector, both of those being pushed higher on reflation expectations broadly. Now, the energy crisis that crippled the power system in Texas and sent prices soaring to record levels is now deepening. An unprecedented deep freeze has led to 5 million people across the US being plunged into darkness to avoid a total collapse of the grids. The cold blast is the latest extreme weather, highlighting how vulnerable the world has become to unpredictable climate events and raises questions about the global push towards renewable energy. For more, let's speak to Jess Shankelman, our energy reporter. Jess, good to speak to you. So does the situation in Texas highlight some of the shortcomings of renewable energies like wind and solar? Because as well as reading about refinery shutdowns and LNG exports being disrupted, I've been reading about blades on wind turbines not able to spin.
Well, yes, absolutely, it does, Anna. And people in the renewable energy industry have been talking for years about the importance of grid, because you can't just, if you have a wind turbine instead of a gas plant, you can't just replace, swap one in for another. You have to really transform the whole energy system. So this has absolutely reignited the debate. Whether or not wind turbines are to blame is another question.
Okay, and so that'll be a debate that no doubt will run. What about energy demands then? Because we're seeing, of course, increased demand for energy in Texas and other parts that have been hit by this unseasonal weather, if you like. Demand rising as buildings are really not optimized in some places for such extreme weather conditions. And certainly having visited Texas a few times, I can vouch for that.
Yeah, so this is a question about climate change, because it causes, it's causing us to have extreme weather events, different weather events to what we're used to, and are the properties we live in and work in equipped for this new kind of weather? So in Texas, like you say, people don't have insulated homes, they don't necessarily have central heating. People are relying on wood to keep their homes warm. And we have to ask about whether our buildings are prepared for these new kinds of different kinds of weather. So I wrote last year about in the UK, we were experiencing, across Europe, experiencing extreme heat waves that we haven't traditionally had, but we're seeing more and more. And homes are starting to overheat. We don't have air conditioning, but we don't also have the kind of shading that you might have in countries like in the Mediterranean or the Middle East, where people are more used to extreme heat. So we're seeing in all parts of the world, people experiencing weather conditions they're not used to.
And just briefly, do we need to put more money into energy transportation? We talked in the summer about rolling blackouts in California, now in Texas.
Yeah, so one of the things we need to look at is how the grid operates, the kind of software and the hardware that we're using. Something that has been used in islands for quite a long time, like the Faroe Islands. I saw a really interesting project there. They use something called demand-side management. So what happens is businesses that can do will be paid to turn down their energy use when supply from renewables drops. So in the Faroe Islands, they have quite a lot of fish farms, and fish farms can actually go for a few hours without energy. So they will get paid
Jess,
by
really
the grid
interesting example to bring to us. Thank you very much, Jess Shankelman, our energy reporter. This is Bloomberg. Welcome back to the European Market Open. 30 minutes into Tuesday's trading session. We see some strength in the London market for sure. The banking sector and the energy markets doing pretty well. Let's have a look at the sector breakdown, in fact, and we might get some clues as to why the FTSE 100 outperforms as it does, outperforming certainly the DAX and the CAC this morning. In terms of the sectors moving to the upside and the downside, we're actually fairly evenly balanced, aren't we? But we do see energy and basic resources moving higher. Autos and parts not helping Germany all that much this morning. The banking sector also moves higher, up by 0.3%. Media was a big gaining sector yesterday with that Vivendi story. It finds itself at the bottom of the pack today, down around 0.5%. Let's get a Bloomberg First Word News update for you, and for that, here's Laura Wright.
Thanks, Anna. The World Trade Organization has chosen Ngozi Okonjo-Iweala to be the first woman and the first African to lead the organization. The former Nigerian finance minister will now have to restore trust in the rules-based global trading system hit by protectionism and the pandemic.
For the first time in the 73 years of GATT and WTO, you are selecting a woman and an African as Director General. This is groundbreaking and positive. I'm grateful for the trust you have in me, not just as a woman and an African, but also in my knowledge, experience, and as some of you have said, courage and passion to work with you to undertake the wide-ranging reforms the WTO needs to reposition itself for the future.
Myanmar's military junta has shut down the internet for a second straight night. It's part of efforts to stem nationwide protests after it seized power from civilian leaders on February 1st. Authorities are trying to disrupt telephone and internet access to make it harder for demonstrators to organize. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Laura, thank you, Laura Wright in London. Now, UK politics and economics now. The Institute for Fiscal Studies says the UK's finances are not sustainable, but the think tank warns that the March budget is not the time to balance the books. Chancellor Rishi Sunak should focus on the recovery instead. Joining us now with further analysis, Carl Emerson, Deputy Director of the Institute for Fiscal Studies. Carl, very good to speak to you. So I take from your research that you do see tax increases coming, but you think March is too soon. Explain the reasoning.
I think March is far too soon. What the Chancellor needs to focus on now is two things. Firstly, the set of kind of emergency support that he's got in place, much of that expires in the next couple of months. Some of that will need to be extended. Some of that will need to be gradually phased out through the year rather than suddenly coming to an abrupt stop. And the second thing he needs to focus on is a strategic set of policies for recovery to help the economy adjust as the UK moves to a new normal, which will be post-COVID, post-Brexit, and also one that moves us towards net zero. That should be the focus of the budget. There's huge amounts of uncertainty about how complete a recovery the economy can make. The more complete that recovery, the bigger bounce back you'll get in tax revenues, the less there'll be need for tax rises in a few years' time. Tax rises are highly likely, but not yet inevitable.
What will dictate whether they are going to take place then, Carl? I mean, it'll be a political decision to some extent, but from an economic perspective, what dictates whether we'll need those tax rises? Does the UK stand a chance of growing its way out of this? Is that what you're suggesting?
I think there's two things that will determine it. Firstly is how complete is the recovery? The fuller the economic recovery, with that will bounce back revenue. So the stronger we get growth over the next few years, the less there'll be need for tax rises. The other side of the coin is to what extent do we want or need to push up public spending as a response to the virus? We know that a load of people have lost 6 months of in-person teaching. We know that the NHS has got big backlogs. There may be other areas of public spending where there'll be demands to spend more, not most obviously perhaps on the health system and on long-term care to get a better quality of service. So it's those two things. Firstly, how strong is the recovery? And secondly, to what extent do we want to spend more as a result of the experiences of the last year?
The furlough scheme has certainly been a real benefit to those who've needed it, to the businesses that needed it and the individuals, Carl. Is there scope now to be more targeted with support? When you compare the UK response with other European countries, the UK response has been more blanket, and there are benefits to that. It's simpler, I guess. But is there room now to be more discriminatory, I suppose, in who receives support and who doesn't?
I think we now have to try and be more targeted. The problem with the blanket approach is that you risk going too fast for some parts of your economy and withdrawing that support too quickly, or alternatively removing it too slowly for some parts of the economy, which means that we won't get the adjustments that ultimately are going to happen. So what we want is a phased withdrawal of the furlough scheme. It does need to be extended a bit, and then perhaps targeted support for areas where there'll be subdued demand for a long time. Perhaps the airline and airports industry would be the most obvious one that comes to mind.
When we come to tax rises, and you say it's too soon, I mean, we might hear something from the Chancellor this time about tax rises to come in the future, or he might decide not to mention too much about that. Maybe you could comment on that. But what kind of tax rises would you think, or tax hikes would be the most appropriate? Clearly, the government has made commitments around not increasing certain taxes, and there seems to be a lot of talk about wealth taxes at this point.
I think not announcing them yet is sensible because we don't know the size that they'll need to be. It's not like we can come up with a plan now and we know that plan will need to stick. It's possible we won't need tax rises, but it's highly likely we will. And I fear that they may need to be quite substantial. Now, the government has said that it won't increase the rates of income tax, of national insurance, or of VAT. But actually, historically, if you look back over time, it tends to be VAT and national insurance rates that get pushed up when we do want to raise significant sums of money. So I wouldn't be surprised if they're the things that the government does choose to do. And while that would be a clear break of manifesto commitments, clearly the virus changes everything, and some other manifesto commitments are going to have to be broken because of events of the last year.
Do you think there is appetite for thinking about a wealth tax at this point, Carl? And what does the international experience of that tell us? Or indeed some of the taxes we already have in place that some call wealth taxes by another name?
There may be some. I think that there's two things I think to bear in mind. Firstly, you have to be very precise about what is the problem that the wealth tax is trying to address. Is it discomfort about the current distribution of wealth and how that was acquired, which I think points very much to a one-off wealth tax to try and correct the past, if you like? Or is it some reason you want to have an enduring, ongoing wealth tax, perhaps one that's levied every year going forwards, which I think in some ways is much more problematic in the sense of the extent to which it will distort people's behaviour, encouraging them to spend rather than to save, hurting some individuals perhaps relatively harshly for reasons that would seem rather odd. And I think fundamentally, even if we did go down the route of having a wealth tax, I don't think it's likely to raise on an ongoing basis the kind of sums we're likely to need. I think it's going to require more than just one tax as part of the solution.
Okay, thanks so much, Carl. Really good to speak to you. Carl Emerson, Deputy Director at the Institute for Fiscal Studies. We will look to that tax conversation, but not yet then. Coming up here on the European Market Open, commodities in focus. Will WTI crude oil, will prices hit $70 or $50 next? We'll put that question to the Market Live team's Ven Ram. He joins us next. This is Bloomberg.
now we need to move forward to make sure that as new vaccines are approved, this approval will happen very, very quickly, and that we will not run behind other countries in terms of how quickly we actually receive the vaccines. So I'm sure that even in Brussels, at the administrative level, at the bureaucratic level, the lessons, have been, we've accepted what has happened, and we've learned our lesson.
You heard there from the Greek Prime Minister Kyriakos Mitsotakis speaking exclusively to Bloomberg. European shares move higher this morning for a fourth day on continued optimism that lockdowns will be eased as COVID-19 cases wane and vaccine rollouts progress. Brent crude edging higher today after closing at its highest in almost 13 months. Bitcoin reaching another record, coming ever closer to $50,000. Lots of moving parts then to discuss with Ven Ram, Bloomberg's Markets Live currency and rates strategist. Ven, oil prices moving higher then, not just because of the reflation trade, but also because of supply concerns in parts of the United States. I know you've been throwing around the question on the Markets Live blog about whether you see 50 or 70 as more likely. What kind of responses do you get here in terms of where the oil price moves next?
I think the voices are predominantly bullish on the oil and reflationary narrative, Anna, and I think that to me, $70 a barrel is more of a possibility given not only the cold snap across the Atlantic, but also the weaker dollar. The weaker dollar plays into the bullish oil story because, obviously everything is priced in the dollars. And I definitely think that even $75 to $80 a barrel that we saw back in 2018 is eminently doable and in the cards. Anna?
And let me get your thoughts then on what's happening in Treasury markets, Ven. We've certainly seen just in the last few days or so some selling of sovereigns and some yields going higher. The yield on the US 10-year now has a 1.22 handle, had almost 1.23% earlier on. I think we're near a one-year high in terms of that yield, and we see a steepness to the curve coming back or increasing. What's the significance of this for you, Ven?
Well, I think this is going to be the market narrative of the first half and indeed the second half in terms of how it's going to guide equities lower, Anna. I think that Treasury rates still have some way to go. They come off the boil. We saw the 10-year rate sitting pretty much unbudged at 65 basis points, about half of as much as what we see now for months on end last year. But there is little incentive, I think, for traders to take those rates so low anymore because of the progress that you mentioned just now, the progress made on vaccination and the promise of an economic rebound. Those really low rates that we saw last year were brought about by multi-standard deviation events. There is just no sound economic case to have those rates that low anymore, especially if you take into account the steep rebound in term premiums that we have seen. Anna?
Yeah, let me get your thoughts on what's going on with Bitcoin then, Ven, because not a day seems to go past when we're not talking about either some further institutional endorsements of Bitcoin or some interesting trading levels having been reached. Today we're around the 49,000 level, so we're less than $100 away from 50,000. I mean, the valuation isn't necessarily based on all that much, Ven. So what kind of analysis goes into it for you when you're thinking about whether we get to 50,000 very quickly?
I do think that we are going to get to 50,000 and probably higher before we see some kind of a pullback based surely on technicals and what have you. I'm not a big fan of technicals, but my analysis shows that Bitcoin is almost 4 times as volatile as gold. But at the moment, the price volatility is all on the upside, Anna, and so it's helping the cryptocurrency. But fundamentally, if you look at the cryptocurrency as a short, it's coming up short as a currency, as a unit of exchange, and as a store of wealth. We all know it's very expensive to mine and that kind of story. At the moment, it seems to have a script that has a label written all over it saying nothing can go wrong. But anyone who's been long enough in the markets knows that the true value of an asset isn't determined by what the next buyer will pay for it. That game is a market game. What I see is an asset that will be volatile for long before its true value is discovered, and it may take years for that to happen. So people need to be as willing to accommodate the downside volatility when prices go down. Will they do that? Will these investors who are holding on to that be patient when it goes down? We will see, Anna.
Really interesting food for thought. I think the Bitcoin price just slipped a little as you were talking there, Ben. I was watching it tick down a little. Thanks very much for your time. Ben Ram, Bloomberg's Markets Live currency and rate strategist. Thank you very much for joining us. 46 minutes into our European trading day, and coming up on the programme, we'll speak to the president of the Eurogroup and the Irish finance minister. That is Pascal Donohoe, of course. We'll discuss the EU vaccine rollout, Europe's economic rebound, and the relationship between the EU and the UK post-Brexit. That exclusive interview brought to us by Maria Tadeo next. This is Bloomberg. Welcome back to the European Market Open. 49 minutes into a European trading session that points modestly to the upside, waiting for the Americans to rejoin the market fray later on today. Now, the European Union's finance ministers are meeting today as the bloc contends with a coronavirus that won't abate and economies that are in recession. The recovery plan will be a key part of the agenda. That's after the European Commission cut its forecast for euro area growth this year to 3.8% from 4.2%. Maria Tadeo now joins us with a very important guest. Maria.
Yes, Anna, good morning. We have a lot to talk about when it comes to the outlook for the European economy. And we're joined now, I'm happy to say, by the Irish finance minister, but also the president of the Eurogroup, Pascal Donohoe. And, you know, Pascal, yesterday, I know that you put out a number of remarks going into the Eurogroup today. And there's one line in particular that I thought was quite interesting and caught my eye, in which you say pulling stimulus too early, too quickly, maybe more risky than doing it too late. So I don't want to put words in your mouth, but to me, that sounds like you're advocating to perhaps suspending the deficit rules for longer and keeping on that stimulus on the table. Is that what you're going to be telling the rest of finance ministers today?
They are decisions that will be made by our colleagues in the European Commission in due time. What you saw in our Eurogroup meeting yesterday is you saw consensus amongst all ministers regarding the continued need to support our economies at a time of such strain. You mentioned the recent forecast from the Commission in relation to the performance of the euro area. It's worth noting that in the final quarter of last year, we saw our economies perform better than we would have expected. And overall, we had an outturn for last year that showed less decline than we feared, but still significant decline and still too many without a job in the euro area today. We're all determined to do what we can to restore economic health as well as public health, and our focus will be on what is the right budgetary policy for the euro area, and our colleagues in the Commission will make a decision on the fiscal rules in due course.
Okay, and you know, just because investors really care, and we know, I mean, this is not a secret, that this is really a source of debate, potentially even tension in the rest of the year over what to do with the fiscal rules and that debate. Yesterday, there was no sense, or you didn't get a sense that this is a debate that is coming imminently, or did you get a sense that actually this is very much on the table and finance ministers want to talk about the rules as soon as possible?
Look, there's always debate, and in the very fact that you are putting questions to me about these issues is in common with the issues that financial markets are raising, that analysts and parliaments are raising all over the European Union and indeed across the world. And it's understandable regarding why those issues would be raised with myself and my fellow finance ministers. But I think there's two areas of certainty that are worth noting. The first one is the consensus that is there regarding the need to support our economies. Massive efforts were put in place in 2020 last year. Now, on top of our automatic stabilizers, which is the effect of our social welfare systems and our tax systems, additional supports of 4% of the shared national income of the euro area were put in place. For this year, we have the Recovery and Resilience Fund that is coming, a signature development from the European Union to support our economies at a time of great difficulty. So all these things are happening. And then the Commission have indicated that at the start of March, you know, they will be outlining some thinking on the issues that you're raising. But the overall picture at the moment is one of a coordination within the euro area and a desire for all of the European institutions and finance ministers to work together to help our economy to recover. And we're determined to do that, Maria.
Right. Right, and you mentioned the recovery fund, and you know, I want to pick up on that because we know that this is a move that's been unprecedented, that the European Commission has been tapping markets and rather well, I should say. But there's also a number of officials who behind the scenes, they tell you it's difficult to come up with a good recovery fund for 2022, 2023, when you don't really know what the fiscal framework is going to look like. Would you say that's a fair point?
Well, it's an understandable issue that has been raised at the moment. I think, though, issues being raised about the fiscal framework in 22 and 2023, while they are still very important issues to be resolved, we have all of 2021 ahead of us, and we've lots of decisions that we can make at the moment that will improve the economic and employment conditions in 22 and in 2023. And my fellow finance ministers within the European Union and within the euro area were very much aware of the need to be able to answer those questions in due course, and they will be answered. But when we are looking at, at questions that still need to be answered, issues that are there in the future, let's, I think, also acknowledge the agreement that is there regarding the measures that we have in place. And we're going to be beginning those kind of discussions on the basis of all that we agree on and the beneficial effect our measures are having at the moment in supporting our economies in dealing with this disease.
And Mr. Donoghue, I have to ask you a final question, but I want to go back to your home country. Right now, NatWest is doing a review of its Ulster Bank unit. Given the repercussions that pulling out from that unit could have, are you confident they're going to stay? Do you have a sense of which way that decision is going to go?
Well, this is a commercial decision that has been made by NatWest, and it is a decision that they will be making, and I believe they're likely to make an announcement on soon. I have been engaging with West on this issue, and I've emphasized to them the really serious consequences that there would be if there were to be a withdrawal of Ulster Bank, which is the bank owned by NatWest, from the Irish economy. They're a really important employer and investor in our economy. I don't have a latest update regarding what their plans are. They're commercially sensitive and they will also need to engage with their own employees as well. But I expect that I will be informed in due course. And to emphasize again, while our economy is doing very, very well and is recovering, of course, any change in our banking landscape is a matter of concern to me.
Right. Well, Pascal Donoghue, head of the Eurogroup, but also Irish Finance Minister, thank you so much for joining us on Bloomberg. We always like to have you here and hopefully see you very soon in person. Thank you so much for joining us. Anne?
Maria, thank you very much. Yeah, we all look forward to those in-person interviews. The possibility of being in the same room as people when you interview them seems otherworldly. Maria, thank you very much for bringing us that interview, and thanks, of course, to Pascal Donoghue, Eurogroup President and Ireland's Finance Minister. That is it for the European Market Open. Surveillance is up next. Surveillance Early Edition, specifically with Francine Lacroix. She'll be joined at 10 a.m. by Matt Miller and by Kaylee Lines to take you through the rest of the morning. European equity markets then in fine form this morning, or at least some of them are, being lifted by the banking sector and the mining space. The CAC 40 and the DAX underperformed just a little. This is Bloomberg.
If you look at the comparison between the US and Europe, the ratio of market cap to GDP in the US is 3 times higher than Europe. We lack gross capital in Europe.
Bloomberg, in our forecast, we see growth coming again in our economies in the second half of this year, and this is strongly connected to the rollout of vaccines.
Every part of the state will be getting either snow or ice.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
The U.S. energy crisis deepens. Freezing weather in Texas disrupts supply and drives up demand. Oil rallies to a 13-month high. Glencore resumes dividends. The world's biggest commodity trader brings debt under control. The chief executive, Glassenberg, signs off with record trading profits. And the reflation debate rumbles on. Later this hour, we will speak to a man with inflation experience. Former ECB President Jean-Claude Trichet joins us exclusively this morning. Well, good morning, everyone. The brand new Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to our top story. And 5 million Americans have been left in the dark as Arctic temperatures in Texas exacerbate an energy crisis. Now, the deep freeze has crippled the state's power system, causing blackouts from Oklahoma to North Dakota. State officials are warning not to go outside.
1 million homes and businesses out of the 2.6 million total served by Centerpoint in our region are out due to state ERCOT outages.
I want to encourage people to stay home, to stay off the road.
Obviously, it's generating demand that rivals almost what we see in the summers. Extraordinary demands on the system for winter in Texas.
But I know we've been asking people to stay home and be mindful of the situation dealing with COVID. This is another challenge that we're having to face.
The forecast is also not great. In some ways, we're still close to the beginning of the incident.
Every part of the state will be getting either snow or ice.
On the asset side, millions of barrels of oil are trapped under the frozen ground. That's driven WTI crude above $60 and pushed local gas prices to 150 times the normal cost. Now let's get more, of course, on this market reaction and what it means in general for energy and the crisis with Danny Berger. Danny, good morning. What market action are we actually seeing? I mean, it's pretty spectacular.
It really is, and it's really across the entirety of the oil and gas space. Nothing is really immune. We're having a ripple effect, be it in heating oil, natural gas. Crude, of course, is one of the ones we've been concentrating. WTI, just 4 cents under $60 a barrel, continues to flirt with that level. But one of the things we have to remember is the fact that it's not just wind turbines that have been frozen. It's everything from natural gas to coal, and that's why we're seeing some other things react. Of course, heating oil, it's been in demand because that is where we see the pressure in terms of heating more of the mobile units, Francine.
Danny, what about the local Texas markets? Prices were actually insane at some point.
Yeah, and look, it has a 9,000 megawatt per hour cap. It continues to hit that. We're seeing it hit it again. The price in the local Texas market skyrockets. It really is a remarkable thing what we're seeing in the Texas market itself. And one of the interesting things also is the consumption numbers have started to fall. And that really represents that the blackout we've seen continues, or at least appears to be continuing throughout Texas, again, because of those consumption numbers that keep falling, which indicates we might continue to see more of this market action, Francine.
Danny, thank you so much. Our markets reporter there, Danny Berger. Now joining us for more is our executive editor for energy and commodities. He's Will Kennedy. Will, what's the outlook for the oil and gas markets right now? How quickly, once the freeze stops, can actually refineries get back to working normally?
Well, it always takes a little time to restart a refinery safely, Francine. So it will, the cold weather is forecast to last for a few days yet, although it may be slightly less cold. And then, you need to take your time. So we're probably looking at an impact that lasts through this week. And clearly, both the outages that we're seeing in the Permian Basin, where many wells are frozen and unable to produce oil and gas, and then the outages we're seeing in oil refineries are going to have a market impact. It's going to cut the supply of oil and fuel into the market at a time when, as Danny said, there's a lot of demand for fuels that are used to heat, like propane and heating oil.
Will, how much worse will it get before it gets better in Texas?
I think it's going to be a tough day today for many people in Texas and in many states outside Texas. I mean, the power outages led to the Southwest Power Pool, which includes 14 states in the west of the country, and there's a possibility that these rolling outages will start to impact Midwest states. So I think it's going to be a tough day today in Texas and beyond. There isn't going to be enough power. A lot of people are going to have at least rolling outages. And although the temperature is forecast to increase a little bit in Houston, it will fall back. So, by the end of the week, hopefully they'll be going back to normal. But in the short term today and into tomorrow night, it's still looking quite grim for people in Texas.
Thank you so much. Of course, our Will Kennedy, their executive editor for energy and commodities worldwide. Now, Smart Conversations on Surveillance Early Edition. Later this hour, we'll also continue our commodities conversation with the chief oil analyst at Energy Aspects, Amrita Sen. But before that, we'll be speaking to a man with first-hand inflation experience. The former ECB president, Jean-Claude Trichet, joins us exclusively at 9:30 a.m. London time. Of course, if you do have any questions for us or for our guests, you can type IB Plus TV on your Bloomberg terminal. You can IB me directly. This is Bloomberg.
It is critically important that the markets stay open in this time as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The World Trade Organization has chosen Ngozi Okonjo-Iweala to be the first woman and the first African to lead the organization. The former Nigerian finance minister will now have to restore trust in the rules-based global trading system hit by protectionism and the pandemic.
For the first time in the 73 years of GATT and WTO, you are selecting a woman and an African as Director General. This is groundbreaking and positive. I'm grateful for the trust you have in me, not just as a woman and an African, but also in my knowledge, experience, and as some of you have said, courage and passion to work with you to undertake the wide-ranging reforms the WTO needs to reposition itself for the future.
Now, Greek Prime Minister Kyriakos Mitsotakis is calling on the EU to ensure there are no more delays to vaccine supplies. The bloc and Commission President Ursula von der Leyen have faced criticism for the slow pace of the rollout. Mitsotakis says it can't afford any more missteps.
we have the capacity to administer many more vaccines that we're currently administering, and we have the infrastructure in place. It's simply a question of getting our hands on the vaccines, and this is, at the end of the day, a European decision.
Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, President Biden is set to step up his stimulus push as America returns to work after President's Day holiday. Amid the new administration's rush for fiscal support, some on this side of the Atlantic are starting to get concerned. Well, Eric Nielsen writes that Europe's planned stimulus falls massively short of its output gap and adds that actually that it's disappointingly slow vaccine rollout. He says the EU is both on a slow recovery path and starting from a deeper hole. Well, is there a risk that Europe becomes a continent left behind? Let's ask Eric Nielsen, UniCredit Group Chief Economist, who joins us now. Eric, before we get to that in a second, I have to say I enjoy all of your morning notes and actually also your Sunday wrap immensely because they really get you thinking about what the role of stimulus also is. But Eric, first of all, when you look at the deep freeze in the U.S. with this Arctic weather really hurting global supplies, making the price of energy shoot up, what does it mean for your forecast longer term?
Well, thanks for that, Francine. First of all, yeah, it's been tough in the commodity markets. So far, we haven't adjusted in our forecast. We had $60 for the oil, and it looks like maybe that's challenged for a while. But again, it's winter time, right? Most of this is the deep freeze, as you said, in Texas and other places, and that has that spike. And central banks will look through this under normal circumstances. And leading to your other point, it of course increases, if anything, the need for help for those who are most impacted by it. But so far we haven't moved our inflation targets or forecast, and I tend to doubt that we will. I think this blows over the next couple of months and will be a parenthesis, if you will, for the winter.
Eric, does it change? I know we're also hearing that, supply disruptions to the vaccines are, hold off because if you lose power, then you can't have the fridges to keep them in the deep freeze. Again, is that something that we worry about but shouldn't change any of the base case because it's limited to the U.S. and to a certain part of the U.S.?
Yeah, I think that's a fair point. It's not something we know how to model as such, but it's clear that the moment you get these type of disruptions to bring it out, and it's not only the matter of power to keep it deep frozen, it's also a matter of trucks driving across, delivering the things and getting the personnel, the healthcare workers out to actually get people to the places. So also this sort of stuff is likely to cause some delays and a concern for sure. But again, as economists, I certainly don't know quite how I put this in, apart from it's one of these sort of risks to everything we do in forecasting. And so far, I have to say, though, that it comes off a situation where the rollout of the vaccine in America particularly has been better than we thought it would be. Quite impressive indeed, I think.
Eric, let's go back to the stimulus debate, which you so wisely put. It's basically there could be a massive gap between what Europe is doing and what the U.S. is doing in terms of percentage of GDP spent in fiscal deficit, and that creates an imbalance. Is it too late to address it, or should we look at it differently?
Yeah, I think there are a couple of very important points that you raise, and I think it is probably too late to address it, if you will. In my assessment, the U.S. probably is doing more than it needs to do. But from a European point of view, that's kind of irrelevant. We have to take that as a given. And I would say, as an economist, I would much rather have my authorities do too much than too little. And in Europe, we are doing too little. On any measure I can calculate and I know of, we're not even trying to fill the output gap by maybe even more than 75% or thereabout, where the Americans are doing 2-3 times more than the output gap this year. So big difference that could have impact for trade policies or the current accounts. It has impact on inflation and spillovers and all the rest of it. So there's a lot of issues now on the table that we have to think about in the market and for policymakers.
Eric, there's a morning must-read, my morning must-read, from the former Bank of England Governor Mervyn King that basically says, the debate should be about the timing and composition of added fiscal support. So he argues that we're focusing on the wrong thing when it comes to some of this recovery package. And he says it's not about whether it adds up to $1.9 trillion support, not stimulus, is what's critical in limiting the damage from the COVID restrictions while avoiding future inflation. Now, on that point, Eric, I think you kind of see eye to eye with Mervyn King, but are you worried that actually the European recovery robustness is put in place if Europe doesn't do enough? Or would you argue, like Mervyn King does, that actually as long as it goes to the right places, it doesn't matter the size?
Yeah, I think Mervyn King has a lot of good points in this. Also, Paul Krugman talked about, don't call this stimulus. This is about a warfare, a healthcare crisis that you have to spend the money that you need and hit it as well as you can. And I am more optimistic in Europe than I am in America in terms of hitting it correctly. America is it's a bit carpet bombing kind of approach where you send checks out to everybody and all the rest of it. It does make some sense in America because America has so few automatic stabilizers compared to Europe. But the key issue, of course, is, and this is why I like the European fiscal approach last year better than the Americans, because it was so much better targeted, in my assessment. My big disappointment this year is that the Europeans are now withdrawing fiscal stimulus as we are still in the middle of this terrible crisis on the hope that maybe late this year it will look better, and it probably will look better. But even with that forecast, it's no time to withdraw fiscal stimulus. But Mervyn King is right that it has to be targeted, and there are a lot to be said about this. But if you don't even put the money out to begin with, there's nothing to target with. So that's my concern.
So, Eric, should we look at running the economy hot? Should we look through inflation just to make sure that we're on a solid footing recovery and then worry about the rest?
Yeah, I think we should run the economy hard if we can, because the downside of not doing enough means scarring the economy and killing potential output down the line. Plus, in my view at least, that from a social point of view, it's grossly unfair for all those who are being hit, and it's particularly the vulnerable in society who have been hit. So I think there's a lot to be said about running it hot. But I don't think there's a measurable risk of inflation. We have been, for 40 years, we see inflation come down. And we admittedly don't quite understand why inflation is so low and not reacting to stimulus in the past, why the Phillips curve is so flat. But then from there to conclude that this time suddenly it will steepen, I find a little bit surprising. There's something to be said about the secular stagnation point of view, probably, and the whole effect of the generational shift, maybe, or whatever. So I find it difficult to put as a baseline scenario that suddenly now, after all the other attempts, the tax cuts in America last year, that this time suddenly we're going to get a lot of inflation. So I'm relatively relaxed about that, to be honest. I would rather see more than less, because the downside risk is not very big in my assessment.
Eric, thank you so much. Eric Nielsen there of UniCredit stays with us, and we'll talk a lot more about Italy and the UK. Now, coming up, Mario Draghi faces a daunting task of fixing Italy's economy. Will he have an extra weapon in his arsenal? The EU's massive fiscal stimulus. We'll discuss that next. This is Bloomberg.
Draghi was stressing, especially in the last years of his leading the ECB, one clear point. We can't have in a single currency area only a monetary policy without a more coordinated fiscal policy.
EU Commissioner there, Paolo Gentiloni, speaking exclusively to this program yesterday. Now, as Mario Draghi gets to work as Italy's prime minister, the country faces its deepest recession since World War II. Deciding how to allocate the EU's recovery funds is one of the earliest priorities of the new government. Well, we're back with Eric Nielsen of UniCredit. Eric, there's so much hope that Mario Draghi will do the right thing, get the priorities right, and also get Italy vaccinated, that we're even talking about possibly Italy launching a 100-year bond. What are the main pitfalls that we should, if not worried, at least be wary about for Italy?
I think the vaccination is a major issue, and I used to worry about the sort of the political backing of a technocrat prime minister, but I was very confident by seeing the composition of his cabinet, which is basically across the board and broad political support. And then I'm worried about, and I have been worried a little bit less today, but I was worried about this contingent of Italian economists, if that's the right way of putting it, who are still too obsessed, in my opinion, with the public debt and therefore putting a damper on what needs to be done on the fiscal side. Because as you said, it has been rough years, and Italy's big problem is that they haven't been growing enough for so many years. And the output gap has grown and grown, and maybe in our estimate, maybe 10% of GDP, which is absolutely huge and needs to be addressed. Cannot be addressed just by the EU funds, but they have to do more on the fiscal side, in my view.
Will they be able to do more?
Yes, I think so. I mean, it's there's about 5% of GDP in the bank, if you will. The outgoing government has already put in for disbursements. In my view, then do another 3 to 5%. The ECB will buy, because that is the policy of the ECB, to prevent any necessary fiscal expansion from leading to a monetary tightening. So you buy the bonds, and we have the PEP program, and it's not only Italy, by the way. You pointed out before, and we talked about briefly. All of Europe, with the possible exception of Germany, but all the other European countries are not doing that much on the fiscal compared to the output gaps and compared to what they did last year. So a coordinated fiscal approach, as Gentiloni said in your little clip, I completely and fully support.
Eric, I also want to talk about the UK, because the IFS came out today saying, look, if the Chancellor wants to balance the books, we need an extra 60 billion in tax revenue. Is there a worry that these kind of conversations come too soon? And so actually, we're talking about getting out of lockdown, but actually raising taxes to make sure that we pay for debt, and it could all come to a head.
Yeah, I was stunned that they say this in London now. I mean, it's a peculiar message at a time when the economy is on its knees. And remember, when we talk about the economic impact of the pandemic, Britain has been hit about double as hard as continental Europe, for example, and more than double than the US. It is really like a 10% decline in GDP, which is like enormous. So and yes, the rollout of the vaccine is good, but that's not resolving all problems in the world. So I was very stunned. One day we have to talk about the deficit has to come down. I'm not worried about the debt numbers so much, because it's sitting on the central bank's balance sheet as it should. Will be there for many years. But the deficit will come down, and a lot of that will come down through the automatic stabilizers. And then we have to talk about tax increases and spending cuts and all the rest of it. But not now.
Eric, thank you so much. Eric Nielsen there, UniCredit Group Chief Economist. Now, coming up, we continue the conversation on stimulus with former ECB President Jean-Claude Trichet. He's coming up shortly. This is Bloomberg. another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
The U.S. energy crisis deepens. Freezing weather in Texas disrupts supply and drives up demand. Oil rallies to a 13-month high. The reflation debate rumbles on. We will speak to a man with inflation experience, while former ECB President Jean-Claude Trichet joins us exclusively in a few minutes. And Glencore resumes dividends. The world's biggest commodity trader brings debt under control, while the chief executive Glassenberg signs off record trading profits. Well, good morning, everyone. Let's stick with the commodity story. And strategists from Goldman to Bank of America are now endorsing raw materials as the next big investment play. JP Morgan has now joined in, declaring that commodities have entered a new super cycle. Well, joining us to discuss all of this is our Danny Berger. Danny, what are the market dynamics that would actually lead to the super cycle?
Well, it's something we're already starting to get hints of, and that's both on the demand and supply side, seeing really favorable environments. Now, on one side, there's this idea that there's a lot of pent-up demand, that there's going to be a consumption boom as economies begin to recover from the pandemic. And of course, we've already started to see that in China, and that's going to the rest of the world. And so you see across the commodity space, you're seeing these pretty sizable gains. It's oil, it's copper, it's lumber, even platinum above $1,300. And yes, some of these do have different idiosyncratic factors in it. You know, we look at oil, we've been talking about this today, the deep freeze in Texas, of course, moving this market. Platinum, it has to do with the auto industry, but that's exactly the point. Across most of these commodities, it is a fragile supply chain, so it's ripe for disruptions. That disruption in the supply then leads to this dynamic where we hear all these strategists say, prepare for year-long gains in the commodity space. And Francine, we're also seeing hedge funds positioning at least a decade high when it comes to their bullishness on commodities.
Danny, we're also seeing how fragile the supply chain is for rare earth minerals. Now, rare earths, of course, very important but unpronounceable minerals. The FT is reporting that China is now exploring curbs for U.S. exports. How big of an effect could that have?
Yeah, you can't pronounce them, but they're in almost everything. These are the kinds of materials that allow electronics to be more efficient, so that means they're on our smartphones. They're also in fighter jets as well, and that means we rely on them a lot. But look, 80%, according to a U.S. Geological Survey, comes from China in terms of U.S. supply. So the issue here is if China did curb their exports, there's little immediate remedies for the U.S. when it comes to short-term supply. President Trump did sign an executive order in October looking for more U.S. mining of these various materials. But again, it's the short-term problem, given this picture, that will be extremely problematic in that scenario, Francine.
Thank you so much, our Danny Berger. Speaking of pronunciation, I think I watched that video of Boris Johnson trying to pronounce the latest drug to combat COVID-19 that was used originally with arthritis about 155 times. His obsession is quite relentless. Now, it's clear by now that the reflation debate will stay with us for the long haul. Central bankers are wrapping their heads around how best to tackle the situation. Our next guest might have some answers. Well, Jean-Claude Trichet was the ECB president between 2003 and 2011. Under his tenure, the euro area saw a spike in inflation of 4.1% in June 2008. Even though there was a short period of deflation in the latter end of 2009, the average inflation over his presidency was 2.1%. Well, I'm delighted to welcome the former ECB president, Jean-Claude Trichet. Welcome to Surveillance Early Edition. Mr. Trichet, I remember your press conferences as if they were yesterday, and you clearly multiple times said, look, you only had one thing to watch, and it was inflation. Now that's moving away from financing conditions expectations. Is this the right thing that central banks should be looking at, given where we are in the pandemic and, you know, given where we are with these stimulus packages?
Well, in my time, as you said, we had ups and downs, and the average yearly inflation, again, since the inception of the euro, was 2.1% or something like that. So we were in line with our definition of price stability. I was looking permanently myself with the Governing Council to the expectations, and anchoring correctly medium, long-term expectations was really the rule of the game. So we were, I would say, we had a needle in our compass, which was maintaining correct anchoring of inflation expectation. I would say, in a way, it's exactly the same today. The only difference is, in my time, it went up and down, and now it is down since a very long period of time. But it seems to me that the objective of the central bankers in all advanced economies and in practically all economies of the world is to try to get to the 2% anchoring of inflation expectation and stick to that with some, I would say, certainty. When you look at what is saying by Christine Lagarde or by Jay Powell and other central bankers, you will see they say more or less the same. The only difference with my time is that they are below this anchoring of inflation expectations around 2%.
Will it change this year because of the massive stimulus package from the U.S.? And will the energy crisis with Arctic freezing temperatures in the U.S. that we're covering today actually make a difference to inflation expectations?
Well, we will see. In a way, it would be very good news, of course, if we could better anchor inflation expectations. It's true that the present period in the U.S. is pushing the prices up, mainly because of this extraordinary situation as regards the wealth and the pressure on the oil and on fossil resources. But we will see. This might be temporary. I mean, we have to look carefully at what will happen. I am more worrying, I have to say, at the present level of values in the stock market, which I consider somewhat artificial, and on the correction which will happen unavoidably, in my opinion, then I am on a real pickup, I would say a very significant pickup of inflation in the US. We will see. We have to remain cautious, of course.
But, Monsieur Trichet, so you're worried about artificial markets, I think is what you're saying. What would be a catalyst for a correction? Is it monetary policy or is it something else?
I think the market can pretty well, without any major change in the overall policy of the central banks and of the Federal Reserve in that particular case, but they can correct themselves. I mean, a lot of observers, a lot of economists are considering that, for good reasons, of course, because all the stimulus, all the central bank very, very active decisions, and they were fully justified, but it has a consequence on markets. And it is absolutely clear that there is an enormous amount of liquidity that are permanently looking for home. It is true in all advanced economy. It is even truer in the US. And that, of course, creates a market which is artificial. Anytime, in my opinion, the overall sentiment of the market can change, and they could consider that it is you're better off at a lower, more appropriate level of values on the stock market in general. But we will see again. I don't exclude anything, but it seems to me that at a certain moment, the fundamentals will be back, and it is normal. And we are not in a very good situation when a lot of observers are really thinking that markets are a little bit artificial.
But, Monsieur Trichet, is there a better way then from central banks to actually, are we just trying to basically suspend the economy and make sure that things don't go bust that are viable? And is that a better way of central banks to do monetary policy rather than keep on doing what they've done so far?
No, it seems to me that what the central banks are doing is trying to, again, get back to a situation which would be more normal, certainly more normal as regards the anchoring of inflation expectations, as we said, and by way of consequence, more normal in the economy as a whole. That does not depend only on them, of course. You have a lot of other factors that are playing in the economies in general, but in the advanced economy in particular, namely the productivity progress, which were very miserable during the last, say, 10, 15 years. You have the level of neutral interest rates, namely those interest rates that are ensuring price stability whilst having full employment, and those neutral rates are very low and abnormally low. So you have to fight when you are the central bank of an advanced economy with the real economy having abnormal features, including, and in my opinion, it is one of the very important elements, this flat yield curve, which is also probably due to a fall, a particularly weak bargaining power of the labor, even in the economies that are at full employment, that were at full employment before the COVID. And that, of course, is adding up to the difficulty that the central bank have, because they, nevertheless, whatever the real economy is presenting to them, they have to anchor inflation expectations and avoid to embark on the deflationary area, which would be really catastrophic. So their policies is justified. They have to be fully lucid of the, I would say, secondary effects of these policies, and they have to call for all other partners to do all what is necessary to change the picture of the real economy, which is behind all our problems, were behind all our problems before the COVID, and have to be solved together with the COVID, if I may. We have to, one, solve the COVID, and second, also solve the problems that were underlying before the COVID.
Mr. Jean-Claude Trichet, thank you so much. The former ECB president stays with us, and we'll talk a lot more, of course, about some of these stimulus packages. We'll also talk about central banks and climate change. Now, coming up, former central bankers enter the politics game. In Italy, Draghi becomes prime minister. In the U.S., Janet Yellen becomes the Treasury secretary. So we discuss also what former central banks can actually bring to the table with Jean-Claude Trichet. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacroix here in London. Now let's get back to Jean-Claude Trichet, the former ECB president. Monsieur Trichet, we have many things to ask you, but maybe let's start with how you're seeing the economies, both on both sides of the Atlantic, the US and Europe, actually behaving right now.
Well, when I look at the last PMI of January, I see a big difference. I mean, the US is really now growing quite fast and rapidly. I see the US composite at 58.7 when the composite in the euro area is 47.8. So that makes a big difference, and it signals that the US economy is going much faster, as I said, which should perhaps have some consequences as regards the famous stimulus. I mean, it seems to me likely that going too far in the case of the US could be a little bit overdone when you have an economy which is really growing very, very correctly, at least, again, if I take a picture of the growth in January. In Europe, I hope that the next generation EU and all the decisions that have been taken will be activating the economy as well as possible. This calls for very close cooperation between both the national budget and the national decisions, and of course the very important next generation EU decision, which should be spent, in my opinion, as well as possible, concentrating, of course, on the future, financing modernization in the future, as the Commission said, and not preserving only the past, which would certainly be wrong.
Monsieur Trichet, I mean, we have Mario Draghi, now Prime Minister of Italy. We have Janet Yellen, now U.S. Treasury Secretary. How useful is it actually to have former central banks? Is the mindset of a central banker different to a politician, and how can that help?
Well, I would say that, of course, the mindset of a central banker is to reason medium-long term. You are judged on what you are doing on the medium term, on the medium-long term. You have promises made to your fellow citizens that are very, very committing and will be judged whether or not you are satisfying the promises that were made in, again, medium-long-term perspective. So I'm sure that Mario and Janet will have that in mind, of course, on top of a very good understanding of the way the real economy functions, on the way economies in general function, not only at the level of their own national economy, but also at the level of the continent, in our case, of course, the euro area, and at the level of the world. So I think that they are both very well prepared to exert this function in a dramatic period, obviously.
Monsieur Trichet, what's the best way for the ECB to actually address climate change? Do they need to get rid of market neutrality?
I think that, first of all, they have a very, very important area where they can concentrate on optimizing their own funds, optimizing the non-monetary funds. And as you know, all the own funds of the euro system is very, very large. So there are a very important domain where they have to be active. As regards the so-called monetary policy area, it seems to me that they are looking at it presently. Some decisions were taken as regards the eligibility of collateral, and they are reflecting, it's part, if I may, of the overall reflection, meditation of the ECB, as Christine Lagarde explained the European Parliament a few days ago, not excluding to do things that would be new, even in the monetary policy area. We will see. In my own understanding, of course, the primary mandate is the monetary policy mandate, and there is no doubt on that. On top of that, you could consider that without prejudice to price stability, as says the treaty, you have to support the overall goals of the European Union. And that, of course, can legitimate some action. But this is very delicate, very touchy, and the Governing Council is looking at it.
Monsieur Trichet, thank you so much for your time today. Jean-Claude Trichet, there, the former ECB president. Now, coming up, Texas plunged into deep freeze with more than 5 million left in the dark as a result. We'll talk about the impact on the oil and gas markets with Energy Aspects' Amrita Sen. Amrita's coming up next, and this is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition, and I'm Francine Lacqua here in London. Now, a big freeze taking a toll on the energy industry. Temperatures in Texas have fallen to 10 below freezing, causing gas shortages and blackouts for more than 5 million people. WTI crude edging higher today after closing at its highest in almost 13 months. Well, joining us now is Amrita Sen, Energy Aspects Chief Oil Analyst. Amrita, unclear, good morning, first of all, unclear how long this will last. Once the freezing temperatures drop, how quickly can the pipelines go back online?
I think once the freezing temperatures drop, I do think oil production and even gas production will be fairly quick to resume. But I do think it's the infrastructure around, particularly refineries, and the power grid is really, really overwhelmed right now. And I think we are hearing reports that, you know, the rolling power cuts could sustain for a while longer, even once, you know, the temperatures, quote unquote, have returned to normal. And, you know, even with the forecast getting warmer, the HDDs, which are the heating degree days, are still substantially higher than the 10-year average.
Amrita, how should we look at this? Like, you know, the longer this lasts, how much oil, you know, can actually be taken off the table, and what does it mean for energy consumption in the U.S.?
I think the most interesting thing, if you ask me, on this is that, look, everybody is focusing on how much shale production is going to get lost. Our estimates are around 8 million barrels, right, which equates to about 250,000 barrels per day across the month of February. That's not enormous, given that we still have stockpiles, though they have been running down very quickly thanks to OPEC's cuts. But I think the critical thing over here is going to be refining margins. What we are going to see, because of the amount of refineries that are shut down, right now, the amount, at the peak, the amount of refineries shut down is double that of what was shut down during Harvey, about 5 million barrels per day right now. We are going to lose 10 to 12 million barrels of gasoline quite easily, and about 7 to 8 million barrels of diesel. What this does do is put us up for a very strong summer, even before demand's picked up. So it's bullish for Brent because refining margins are going to pick up.
Amrita, does this actually, I mean, longer term, does this have implications for energy distribution in the U.S.? Are they going to be less reliant on electricity and climate change because it's very difficult in these kind of situations to deal with, energy supplies?
I think this is a critical question, really, and I think you've already started to see a lot of talk around, wind turbines that have ice and it got frozen and how you kind of need fossil fuel. Obviously, Texas is very much at the heart of the fossil fuel industry in the U.S. They are going to use this as an example to say why green energy doesn't work at critical times like this. Overall, though, they just need the Texas system. It needs an overhaul. And I think this is probably going to serve as a very timely reminder that they do need a more balanced system, a more balanced grid.
So what does it mean, Amrita, in terms of Joe Biden's aspiration to become greener? Does it actually change it at the margins, or could it significantly impact his ambition?
I don't think it's going to change his ambitions, right? And at the end of the day, regardless of what's going on in Texas, at the state level, whether it be California, whether it be New York, they are still going ahead and pushing for the green agenda. And of course, Biden has rejoined Paris as well. So the overarching theme is not going to change. But again, this is a reminder, just like what we had in Japan, for instance, just a few weeks ago, the cold blast there that resulted in a lot more liquids being burned, that, oil, gas, it's not going away anytime soon. I think we do underappreciate the scale of transition that is required if we are truly to get to net zero. And I think that's where the industry, this is a timely reminder for a wake-up call, really, in saying that, yeah, we absolutely need fossil fuel in the mix. It's about how we get it greener.
Amrita, thank you so much. Amrita Sender, Energy Aspects Chief Oil Analyst. Now, Bloomberg Surveillance, the early edition, continues in the next hour. Of course, it's our launch day. Matt Miller joins me out of Berlin. Kaylee Lines joins me from New York. This is Bloomberg.
Day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
every part of the state will be getting either snow or ice.
I think there's been a very prolonged period of underinvestment across the commodity complex, not just in energy, and that will have an impact on supply availability for some period to come.
We have the capacity to administer many more vaccines that we're currently administering, and we have the infrastructure in place. It's simply a question of getting our hands on the vaccines.
The question is, when does this overshoot stop? And it stops when the Bitcoins have reached basically critical mass in the economy.
Bitcoin could easily double in value, maybe even treble in the next 3 years.
This is Bloomberg Surveillance, early edition, with Francine Lacqua, Matt Miller, and Keely Lines.
Live from London, Berlin, and New York, I'm Francine Lacqua with Matt Miller and Keely Lines. Our top stories today. The U.S. energy crisis deepens. Freezing weather in Texas disrupts supply and drives up demand. Oil rallies to a 13-month high. Glencore resumes dividends while the world's biggest commodity trader brings debt under control. The chief executive, Glassenberg, signs off with record trading profits. And the reflation debate rumbles on. Mark Hafele, UBS Global Wealth Management Chief Investment Officer, weighs in just a few moments. Well, good morning, everyone, and welcome to Bloomberg, the Surveillance, the early edition. Actually, a lot going on. I know, Matt and Kaylee, that we look, of course, at the deep freeze. 5 million people without energy at the moment because they try and preserve the energy freeze, Matt. And, of course, the big question, what does it mean for energy distribution in the future? And, of course, the composition of what Joe Biden wants to do with climate change.
Yeah, absolutely. And, we keep throwing around the number 5 million. It's actually more like double that because 5 million homes without power in the U.S., but the Texas issues have caused cascading power outages into Mexico, and that blacked out another 5 million homes there. So it's really more like 10 million people that at least temporarily were without power. That means they couldn't run their heating, but it also means the internet shut down in a lot of places. It also means flights were grounded in a lot of places. Keep in mind that hospitals
and vaccinations
have hopefully generator systems, but still rely on power. And so it's really more important than just not being able to watch TV.
Yeah, much more important than that. Of course, it has a huge repercussion for the supply chain. I would, of course, as far as I understand, is that they're also shutting off, power grids to make sure that the main grid actually remains viable. Then we're getting some euro area GDP a little bit better than expected. ZEW, February investor expectations also better than expected. Kaylee, what are you seeing in the markets?
Well, broadly speaking, Francine, that risk-on reflationary trade is continuing this morning. Global stocks actually rising for 11 days in a row. That would be the longest winning streak since all the way in 2003. You do have stocks in Europe higher and futures following suit, up about 20 points on the S&P 500. And you're seeing bond yields continuing to inch higher, again, part of that reflation trade. The 10-year yield right now sitting at 1.24%. That is the highest since going back to February of last year. But really, as you guys were just speaking about, the story here in the U.S. this morning is about that deep freeze in Texas and the energy crisis that has followed. That has natural gas futures and oil higher as millions of barrels in capacity per day are shut offline, and it isn't just when it comes to production, it's also when it comes to refining. But that lift in oil prices in and around $60 a barrel on WTI is giving a nice lift to the energy sector as well. The energy select sector, SPDR, that's XLE, in pre-market trading is higher by about 2.5%. It is energy that's looking to lead the charge on a sector basis at the open, at least given the pre-market indications. And you can see a number of energy stocks higher. Occidental Petroleum up 4.3% in pre-market trading, Matt, and I know you're keeping a close eye on oil and energy as well, Matt.
Yeah, exactly. And I think, the Reddit story comes into this a little bit as well, because retail traders are getting into calls in a big way on WTI. So if you look at energy prices, you'll see multi-year highs. We haven't seen these levels since 2017, 2016. If you look at WTI calls here, we've never seen a number like this ever in the history of the universe. So this chart only goes back to 2010, but look how high we are in terms of call purchases. You can, I double-checked, buy these is on Robinhood. So I think a lot more investors are getting in on this than ever have before, and it'll be interesting to see if, the majority of these calls are $100 options. It'll be interesting to see if we actually get oil headed that high. Remember, we're only talking about crossing $60 right now. Fran?
Yeah, Matt, I love remember what happened to silver. And I guess the question at the time when we had the GameStop retail frenzy was whether it could actually touch the oil markets. Now, to talk about, of course, the deep freeze, the Arctic freezing temperatures over in the U.S. this morning from Zurich is Mark Hafele. He's Chief Investment Officer at UBS Global Wealth Management. Mark, as always, thank you so much for coming on. If you're a central banker now, do you actually look through some of this temporary inflation because of the Arctic temperature? Does it actually change what you want to put in your portfolio?
Well, I think that the central bankers will look through in terms of inflation, and that's an important story for the rest of this year. But, as a Texas resident, I would say that, Texas and the Fed there have really looked at the impact of climate change on portfolios and the growing risks there. And in some ways, they've been a leader on that. And I expect that this deep freeze, which, hasn't been seen since the 80s, it really is significant in getting people to think differently.
Mark, I didn't know you were from Texas, so we hope that your family, of course, are all safe and well and have power at least at times. When you look at, the longer term, how does the Biden administration, very, green, trying to do a lot more with climate change, how do they navigate this?
Well, we think that building back better around the world will involve more green strategies. And, last year and continuing into this year, our most successful investment strategies and our fastest growing are around sustainable investments, because people around the world see that's where the money is flowing and that's where the opportunities are. So we expect that the United States will build on that to a degree and try to play catch up a little bit with the fund industry, and both in Europe and Asia, where funds are flowing towards those kind of sustainable investments.
When you look at the rally that we're seeing, I mean, it doesn't seem to have been held back by this at all. Quite to the contrary, the everything rally is pushed a little bit harder when you get the commodity bids in. Is bad news good news right now, Mark? I mean, is the idea that, we're going to get stimulus for everything that happens? We're going to get the central bank backing up every single little hiccup that we see?
Well, this reflation trade, is historic. I mean, you just had a remarkable interview with Mr. Trichet where he said that he believed the U.S. was going to put too much stimulus into the economy. And I think that it's not for me to say that things are right or wrong, but I think that the idea that has taken shape with the Fed and the Treasury, backed now apparently by the Congress, that stimulus will be applied, fiscal and monetary stimulus, to bring the U.S. economy up to full employment, is a freight train that few institutional investors want to get in front of right now.
We also had, we had that interview with Trichet, which was fantastic. We also had a Bloomberg opinion piece by Mervyn King where he was saying this, you need support, not stimulus at a time like this. And coincident with that, we had a report from Danske Bank that the ECB was going to buy more bonds than it has in any week since June. So do you think we're seeing central banks and government stimulus go so far as to really make inflation a big concern?
Well, I think that central banks know that they have tools to fight inflation, but whether they, in the United States where they want to avoid negative interest rates, or in Europe where I don't think negative interest rates have worked that well, the tools to fight deflation are suspect. And I think that is in particular why at this point, the concern about creating some inflation is important to policymakers. And we also think that it can be positive for the stock market over the course of this year if we saw a little bit of inflation taking hold.
It's not just about inflation either when it comes to central bank policy, though, Mark. A lot of concern is that there's so much liquidity sloshing around that it's leading to asset bubbles. Are you worried about bubbles here, or at least froth?
Well, I think that like everyone else in the market, we do see individual stocks or certain assets moving up. But I think that, we're far from the levels where it's a systemic risk around a large asset like housing, like it was during the great financial crisis. And also, to have a kind of systemic bubble, in part that has to happen when the liquidity dries up and the central banks are pulling liquidity out of the system. And I think that's why in this phase, the central banks are going out of their way to say, even if we get some inflation in this spring, they're willing to look through that because they don't think it's going to be sustained as kind of systemic inflation. So I think in that respect, it's kind of a unique environment where you will see these individual assets pop up, but we do not yet see kind of the systemic risk from that asset price inflation.
Mark, you're expecting further upside to equities. Jean-Claude Trichet is actually expecting a correction in the markets because he says it doesn't really track the real world or the real economy. If there were to be a correction, what would be the catalyst?
Well, I think that the catalyst will be, there's two. First, we expect now that the hospitalization rate will fall along with these new case counts in the COVID. And to the extent, we don't think it's probable that there's a hiccup in the recovery on the COVID side, that always has a chance to prolong the recovery and make different sectors perform differently. But I think the big risk is around when we get that recovery and you start to get some supply imbalances as certain things are undersupplied and prices go up, that if the central banks or investors lose faith that the central banks are indeed planning on keeping rates low for some time, we could get something of a shock around that. So those are two things that we're thinking about. And, I would say in this historic period where you have fiscal and monetary stimulus and the pandemic, there will be volatility, and investors should expect that and take advantage of that. But if you can look through that to a degree and think about where the market can end up on the back of this stimulus and where the economy and earnings can end up on the back of this, staying invested in risk assets makes sense over the medium term.
Mark, thank you so much. Mark Haefele there, of course, also expecting, I think, dollar to weaken, and he likes emerging markets, so we'll talk about that shortly. He's Mark Haefele from UBS Global Wealth Management. Now, later on Bloomberg Surveillance, Texas Railroad Commissioner Jim Wright. That interview at 8 a.m. in New York, 1 p.m. in London, and this is Bloomberg.
Tune in to today's Options Insight, sponsored by Thinkorswim by TD Ameritrade.
With a bang, energy and change came to every part of our universe. Seismic or small, it continues.
Change is all around us, shaped by technology and human ingenuity. We can make it work for you and your business.
Folks, the world's first fully autonomous vehicle is almost at the finish line. Today we're going to fine-tune the dynamic braking system.
Woo! What a ride! I invested in Invesco QQQ, a fund that invests in the innovators of the NASDAQ 100, like you.
You don't have to be a deep learning engineer to help make the world a smarter place.
Does it come in blue?
Become an agent of innovation with Invesco QQQ. We're Weaver, a national CPA and advisory firm. And we firmly believe that when you put people first, the numbers follow. Weaver, accounting for more than numbers.
Some say this is my greatest challenge ever, but I've seen centuries of this, with a companion that powers a digital world traded with a touch. The gold standard, so to speak.
There are plenty of road closures you're going to want to know about if you're planning to hit the slopes today. And we're just getting word from the highway. Parking lot, there's just no movement at all down there.
The only adventure sales event is happening now. Land Rover, above and beyond.
This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua here in London, Matt Miller in Berlin, Kaylee Lyons in New York. Now, still with us, Mark Hafele from UBS Global Wealth Management. Mark, we were talking a bit about the reflation trade. I think we touched on equities. I know you also like emerging markets. Is that part of the reflation trade, or is it also a structural reforms put in specific countries?
I think it's part of the reflation trade. We're seeing the flows to emerging markets, and we think that the liquidity, so much of it, as you described, is spilling out into the emerging markets.
What does that mean for where you see the best value, Mark? I mean, again, does this link back to the dollar? If there's a surprise with central banks, what does it mean for emerging markets?
Well, I think that the dollar situation, the weaker dollar, can help commodity players. But another part of it for us is the growth that we're seeing in Asia, the fact that Asian recovery is well on track, and we're looking for opportunities there, in 5G, health tech, med tech. So it's really broad-based, not just a commodity play.
So you don't see the supply chain having been shaken up that much? Because at the beginning of the crisis, we were talking about it's necessary maybe to move manufacturing closer to home in case it breaks down. That didn't happen.
Well, look, the supply chain story, we're seeing some price spikes as those things continue. But if you look in particular at the Asia story, that is a domestic or a regional consumption play. And so I think, and actually another reason we like that is you get that balance, say, between the 5G tech build out in the United States and the build out in Asia. So that difference is something we're playing as well.
What do you think about the valuation difference, Mark? And I mean, Fran's dollar comment is also incredibly important, but the valuations in the U.S. have been sky high. What do they look like in the areas that you prefer?
Well, that's a two-edged question. I think in the United States, on the back of this recovery, the valuations are cheaper in the small caps and the cyclicals, and we see opportunity there. But overall, in the emerging markets, when you get a recovery like this, typically they outperform developed markets for some time, and we haven't seen that yet. So that better valuation picture is also something we like in emerging markets.
Speaking of valuations, though, Mark, I mean, specifically in U.S. growth stocks like technology, at what point is higher yields going to be a disruptive force for those kind of equities, given the 10-year yield is back around 1.25% at this point?
Yeah, I think that the yield is an issue, but also just the expectations around growth rates from here are extremely high, and that's why we would rotate some of that exposure into the laggards that that didn't do so well during the work from home period, and that extends to the fact that we just really see this recovery speeding up here now in the United States as these case counts plummet.
Do you worry about those trades getting too crowded, though? Everyone seems to be calling for go for the cyclicals, go for small caps in 2021. That seems to be the narrative. And the Bank of America Fund Manager survey that was just released this morning says allocation to equities and commodities is at the highest since 2011. Do you worry about overcrowding right now?
Well, small caps in the United States have underperformed tech for 10 years. So I do think there's quite a ways to go. And the valuation gap is something like 30% for small caps trading versus large caps. So I'm not worried about that yet.
Mark, the premise is that the recovery will take hold. The premise is that we're vaccinating people and that will only ramp up. What about variants? What if the economy is not performing like your base case or the central bank's base case scenario?
Well, I do think that if our base case doesn't happen and it does take longer, that will slow the recovery and, likely make calls for more stimulus, and it will have a market impact. But keep in mind, I mean, the focus originally when we went into this was on hospitalization rates, and the idea that ICUs filled up were the reason that we had to do shutdowns. And I think as these case counts fall, even if there's new variants, we're not, with the vaccines, while it doesn't prevent infection, it seems to be preventing those higher hospitalization rates. And so as long as the hospitalization rates continue to fall, the policymakers have a lot more options and the recovery should continue.
Okay, I think Matt Miller, Mark, wants to ask you about Bitcoin. Are you giving Bitcoin to, your portfolios?
I just saw your note, Mark. I just saw the note you put out a couple of days ago saying it's not ready to go mainstream, and yet we see BNY Mellon and going in, Morgan Stanley considering adding it. Why do you think it's not ready, and when will it be?
Well, look, I think for many clients, nobody wants to miss out on the next great thing. But an asset that has the same volatility per day that stocks have per year really has the chance to derail somebody's portfolio. And I think American investors are also, have to think about something where the Treasury Secretary is raising real specific concerns about that asset class. So, people want to speculate with part of their money. We understand that, but we're focused on long-term portfolio construction, and that's where I don't think it's ready for prime time.
Mark, thank you so much. Mark Hefele, we're ready for prime time. Chief Investment Officer at UBS Global Wealth Management. Now, a little bit later today, we also speak with Ken Moelis, Moelis & Company Chairman and Chief Executive. That interview coming up 10:30 a.m. in New York, 3:30 p.m. in London, and this is Bloomberg.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Hi, Bitcoin. Low fees. Osprey Bitcoin Trust is the lowest cost tradable Bitcoin product, all from the comfort of your brokerage account or your IRA. Just remember OBTC and say goodbye to high fees.
My hair loss was a reminder of my age. Like, is this happening to me now? When I started first seeing results, I got excited. I love my new hair. It makes me feel a lot more confident. The things I love about Roman are the simplicity, the confidentiality, and the fact that it works.
Here's AJ.
When are you going back into the office? I don't know, Dad.
Well, we have a safety net.
We'll be okay, right?
Tommy John is for men who value themselves and their comfort, who want fabrics that are lightweight, breathable, and insanely soft, with stay-put waistbands that adapt for the perfect fit. 360-degree stretch prevents ride-up and supports any move you make, and mind-blowing innovations like our Quick Draw Fly. We've also reinvented loungewear. Yeah, loungewear. You can trust our thousands of 5-star reviews, because Tommy John knows how comfortable you want to be.
Hurry, go to TommyJohn.com now for 20% off any 5 items.
Gender is the social aspect of our biological sex, but it is a performance and it's something we can play with and we can challenge.
The human body is a very, very liminal space, and we need to start redefining how we see ourselves in that way.
Gender has become a more fluid thing. People are much more interested in presenting themselves in the way they want to be seen rather than the way they have to be seen.
Hyundai Motor, connecting art and technology.
You could think getting commission-free trades is as good as it gets, but you know better. At Schwab, free means more. You get commission-free online trades and quality trade executions on our powerful platform. Plus the satisfaction guarantee. Expect
preparing to hand over control to the head of Glencore's coal business, Gary Nagle. And it's a double first for the World Trade Organization. The WTO has named the first woman and first African as its leader. The former Nigerian finance minister, Ngozi Okonjo-Iweala, will serve a 4-year term as director general. She says her first priority is to make it easier for poorer countries to obtain coronavirus vaccines. And this, Matt, of course, underpins everything that we're trying to do in terms of the world order. One of the other big challenges is, of course, bringing U.S., China maybe talking at the same table again.
Yeah, she also previously was the chair of the Global Alliance for Vaccines, which is huge. And she's also trying to find a solution to the e-commerce tax issue. So there's so many issues that make this a really important story.
Yeah, we'll have plenty more, of course, on WTO and the markets. This is Bloomberg.
Animals across the globe are dying by alarming rates. A report by World Wildlife Fund and the Zoological Society of London found that populations of mammals, birds, amphibians, reptiles, and fish fell by 68% in the last 50 years. In the tropical Americas, the rate was worse, with a 94% decline in the same period, and the size of observed wildlife populations in or near freshwater globally have fallen by 84%. Continued human abuse of the planet may lead to the collapse of the systems and resources that allow global civilization to persist in the first place. Overfishing and hunting, invasive species, pollution, habitat loss, and climate change are the main causes of this animal population crash. The report compiles evidence from 4,392 different vertebrate species and concludes the evidence for humanity's destruction of biodiversity is unequivocal. Using powerful computer models to simulate policy that stops biodiversity loss, scientists have explored scenarios to slow the trend. Such measures would include expanded conservation, increasing agricultural yields while also eliminating food waste, and cutting the global meat intake in half. By changing what the world eats and how it produces that food, nations could stop this tragic loss of life by almost 50%.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Welcome back to Bloomberg Surveillance Early Edition. I'm Matt Miller here in Berlin with Francine Lacroix in London, Kaylee Lyons in New York. As you can see, the famous Brandenburg Gate here is being clouded out a little by the snow. If I weren't already on lockdown enough due to lockdown and the 4-month-old baby I've got at home, this makes it even worse. I guess the weather, though, is probably just as bad in London and New York, right?
Yeah, Matt, I need to know what temperature it is.
I just watched, by the way, The Day After Tomorrow yesterday, so I feel like the whole world is just being covered with this snow and cold front that's shutting everything down. It's a global warming catastrophe.
Yeah, but just for the record, you're not in a blackout. So you have power in Berlin, unlike Texas, where you have huge refineries being cut, and of course, Joe Biden saying that there's a state of emergency in the state of Texas.
Yeah, I mean, it's 3 degrees in Dallas.
None of that's hurting the markets, though, Kaylee.
Well, it's reflected in the market. 3 degrees in Dallas, which I just think is crazy that Texas can even get that cold. I didn't know that it was possible, but you are seeing it reflected, this energy crisis, when it comes to natural gas and oil specifically. Natural gas, 10 billion cubic feet of gas production is shut right now in Texas and in the southern United States. That has futures up by around 5.5%. And then, of course, about 1.7 million barrels per day of oil production has been shuttered. Refiners, some of the largest in the country, have had to close operations just because of how cold and how terrible the weather is. That has WTI right in and around $60 a barrel. With that, energy stocks getting a big lift this morning. XLE, which is the Energy Select Sector Spider, up around 2.4% in pre-market trading. If you're going to look for an outperformer at the opening bell, you can bet it is going to be energy full stop. A number of them are higher. Even Exxon, which had to shutter its Beaumont refinery because of the weather is higher by about 2.5%. And really the energy complex across the board is getting a lift today, Matt.
Yeah, well, and we're seeing also a lot of buying in options. This is, I think, very interesting considering the retail investment story. This is WTI calls soaring to the kind of record, exponentially more than the previous highs that we've seen. And these options are mostly around $100 contracts. So they're betting that the price of oil goes way past 60, 70, 80, and 90 to $100. That would be a huge gain. And I double checked. You can buy WTI options on Robinhood. I also looked on Reddit for a while, didn't see very much about it, but it's interesting to think, if that crowd gets into this, could they really move such a big market, Fran?
Yeah, and this was one of the main questions, Matt, that we were trying to figure out. But of course, it's much more, fragmented, a little bit more like silver because of it's a much larger market. So I don't know if you can move it in tandem, but certainly it points to a deepening energy crisis in the U.S. Now, to talk about the Biden administration, the stimulus, now that the trial of former President Donald Trump is over, and of course how Biden and his administration deal with this deepening energy crisis, we're delighted to be joined by our Bloomberg editor-at-large. He's Marty Schenker. Marty, I know we look at the deep freeze, the Arctic temperatures over in Texas. Is this the first real crisis that the Biden administration has to deal with, apart from impeachment?
Well, it's not the first big crisis they have to deal with. They inherited a faltering economy, a virus epidemic, but this is the first one where they have to show their mettle in terms of reacting to a natural disaster. And, Joe Biden declared a state of emergency in Texas pretty quickly, as opposed to how long it took Donald Trump to make those declarations.
What are we expecting for the Biden administration? They've pointed so much to, energy dependence of the U.S., climate change. How much does this change the narrative around that?
I don't know that it changes it, but it will cast a spotlight on just how efficient the reaction is. This is more than just a Texas problem. It's, as you've reported, it's spreading across the country. So he has to and his emergency preparedness has to show its prowess here, so that it doesn't spread even wider than that region.
Marty, Trump didn't invite Joe Biden over for coffee or tea or, well, even show up at his inauguration, but he did leave him with a system that was already vaccinating basically 1 million people a day, and that has been ramped up substantially since Biden came into office. How long is it going to take to get to 200 million, 300 million shots?
Well, I mean, that is a key question. The experts say it's probably sometime this summer. If you're able to get, the vast majority, 80% of Americans vaccinated, then you have herd immunity and things can start opening up, and that is the target. And so far, it looks like that's quite possible that the spring or early summer is when you could get to those numbers.
So the vaccinations are a key part of his job. Dealing with the economy also very important, in the labor market. Then he's got to reach out to his global partners and try and repair the damage in a lot of cases that the Trump administration has done. How hard is that going to be?
It's going to be pretty difficult. You did hear Janet Yellen call on the G7 nations to, act big, just like the U.S. is poised to do with its almost $2 trillion stimulus. So his economic team is asking its partners to join the United States. But of course, if the United States runs hot, that will affect the global economy as well.
Marty, you mentioned that nearly $2 trillion stimulus package that the president and congressional Democrats are trying to get pushed through. Is that job now easier now that the impeachment proceedings are over?
I think a lot of things are easier now that the impeachment thing is over, and stimulus certainly is one of them. I think the Biden White House breathed a sigh of relief when there were no witnesses called at the impeachment trial, and so it ended on Saturday. And now they can concentrate on stimulus, and they need to get this done within 4 weeks, and that is the plan, to actually pass this bill through Congress by the middle of March.
Yeah, March 14th is coming up really quickly, but the mechanism through which they're looking to pass this measure is largely going to be just partisan. Democrats trying to push this through budget reconciliation. And fiscal aid is something that is kind of a bipartisan issue. What does it indicate for industry spending, for the green spending that the Biden administration wants to put through if we can't even reach consensus when it comes to fiscal aid?
Well, it's interesting. Joe Biden lived through the passage of Obamacare with no Republican support, and that turned out to be controversial. But that is something that the American people itself were relatively divided on. The stimulus package seems to have a lot of popular support. So I think it will be less controversial than Obamacare to push this through, even if there are no Republicans who join.
Marty, you get to come back tomorrow at 5 a.m. if you know how to pronounce some of these rare earths that, according to the FT, China is looking to actually limit the supply of, mainly to hurt U.S. defense contractors. Are we going to see an escalation of this trade war between the U.S. and China?
Well, it's, Joe Biden finally made that call to President Xi of China last week. They are still trying to figure out just what kind of stance they need to take with China. And these reports only make it more critical that they come to some internal consensus on how to deal with China. And I think that's still developing.
All right, a 2-hour conversation between the two presidents. It's like a surveillance meeting after the show. Bloomberg editor-at-large Marty Schenker there with the very latest on President Biden. Now, coming up, Gideon Rose, Foreign Affairs magazine editor and CFR distinguished fellow. I know he'll have a thing or two to say about the World Trade Organization, a new head, and of course, the China eyeing these rare earth export curbs for U.S. defense. That's according to the FT. We'll talk about it with Gideon Rose at 6:30 a.m. in New York, 11:30 a.m. in London. And this is Bloomberg.
Giuseppe Conte's government, I think it's time to give the country in the very good hands. Mario Draghi is the best man to be prime minister. He saved the euro, he will save Italy.
We are going to lose 10 to 12 million barrels of gasoline quite easily, and about 7 to 8 million barrels of diesel. What this does do is put us up for a very strong summer, even before demand's picked up. So it's bullish for Brent because refining margins are going to pick up.
Well, that was Amrita Sen of Energy Aspects earlier talking to us about when she thought pipelines would get back online once the Arctic temperatures in western U.S. would subside. Now let's get straight to our first word news, and that's where we start. An unprecedented deep freeze from the Dakotas to Texas has triggered an energy crisis, and that's left at least 5 million people in the dark. Now, Texas's power system has been crippled, rolling blackouts have been imposed, and grid managers cannot say exactly when they will end. A surprise admission from New York Governor Andrew Cuomo. He says his government mishandled data from coronavirus-linked deaths in nursing homes. Now, Cuomo admitted he did not answer questions about the total death toll from lawmakers or reporters. A Cuomo aide told lawmakers the state withheld data because it was afraid the Trump administration would use it to start a federal investigation. And Chancellor Angela Merkel wants to make a deal with the U.S. over the controversial Russian pipeline that will bring natural gas to Germany. It's been a particular source of transatlantic friction. While construction was halted for a year after the U.S. imposed sanctions, Merkel's coalition is working on a plan that would attempt to soften Russia's influence over Europe's energy market. And finally, another record for Bitcoin. The world's largest cryptocurrency rose today, closing in on a $50,000 level. Bitcoin has risen fivefold over the past year. Still, there are warnings that investors could be left with big losses because cryptocurrencies remain highly speculative. And our resident expert is actually Matt Miller, who got onto the Bitcoin craze 10 years ago when it was at 100. Matt, when you look at what's underlying, Bitcoin, so part is just a lot of the younger crowd wanting to take, I guess, a more established Wall Street, and then suddenly over the last 6 days, you have a lot more Wall Street players want to get a piece of the action.
Yeah, well, I mean, there have been some big Wall Street players in there for a while. Alan Howard, Paul Tudor Jones, and a number of really legendary names have started to embrace it. But, you're right. 10 years ago, if you had put $1,000 into Bitcoin 10 years ago, just $1,000, and then left it there, that's a big night out at Nam Long. Have I ever? Yeah, well, I've bought I lived on Bitcoin for a couple of weeks, so I bought everything from groceries in Greenpoint, Brooklyn, to beer at a bar called EVR downtown. I actually bought Battlefield 4, I think, at GameStop with Bitcoin, and I used it to put gas in the car. So it's possible, but that's not really the point of Bitcoin right now.
Well, what is the point of Bitcoin right now, I think, is the question that everyone is asking. Because if it's supposed to be used as a currency, currencies don't trade in and around $48,000 worth. And you are seeing some get into it, like Tesla. Matt, if you could remember your Bitcoin password, you could probably buy yourself a Tesla. And of course, it also made that $1.5 billion investment into it last week. Scott Minerd, although he did say Bitcoin could go up to $100,000. But Mike Novogratz over at Galaxy Digital saying every company is going to have to get into Bitcoin, allow people to transact in Bitcoin. Although Tesla, I wouldn't say is like any other company.
He's been an early backer, but I will point out other currencies appreciate as well, but just maybe not at this speed. Fran, if you put $1,000 in Bitcoin 10 years ago, you'd have $49 million today.
I know, not to buy a lot of coffees, but Matt, the concern I have is that every time we talk about Bitcoin, I get love letters and hate messages on Twitter, and there's just so much love and hate, and it kind of really, there's so much kind of the pro-Bitcoin that makes me a little bit nervous about what exactly Bitcoin is. Now, coming up in the next hour, Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramovitz. That's live on TV, an extended Bloomberg Surveillance simulcast from 6 a.m. in New York, 11 a.m. in London, and this is Bloomberg.
These solar arrays that we're going to install are going to be about half the size of the existing solar arrays that we have on the International Space Station. But because of the advances in technology over the years, they're going to provide about twice the power in just half of the area that the existing solar arrays cover.
Let's just start with the numbers.
And it would be essentially free cash flow positive in 2021. That was sooner than people had been expecting.
We have pretty good numbers here in the biggest divisions of Morgan Stanley. They are firing on all cylinders.
We've had this huge rivalry historically between Morgan Stanley and Goldman Sachs.
There are 24 reasons for Mr. Diamond to celebrate today.
As much as people may want to focus on trading, for Bank of America, it's all about credit.
It seems the markets are very happy with Trump. They're very happy with Biden.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
It's true that the present period in the U.S. is pushing the prices up, mainly because of this extraordinary situation as regards the wealth and the pressure on the oil and on fossil resources. But we will see this might be temporary.
Well, that was the former ECB president, Jean-Claude Trichet, talking to us earlier. Now, Tom Keene, anchor of Bloomberg Surveillance in the Next Hour, joins us. Tom, I know you're looking, as always, at Turkish lira. I know you're also looking at pound, and pound actually, the narrative on pound ever higher is one you'll focus on extensively.
Turkish lira through 7 lira. It's obscure right now. It's idiosyncratic, but it really links right in with the risk-on feel, Francine. This is a remarkable shift for us over a long 3-day weekend. Right now, Francine, Tuesday is different than Friday. And where you see it beautifully, Francine, is in pound sterling. I mean, there's like 8 numbers on the Bloomberg terminal that scream reflation, scream risk on, but a 139.39 on sterling, that leg out that we're seeing, Francine, is something.
Yeah, so if you look at sterling, I mean, you know, we heard from Boris Johnson yesterday, Tom finally wanting to get out of lockdown and says he wants this 3rd lockdown to be the last. I'm not exactly sure what the plan is, but you can see that how they managed to do vaccinations actually much quicker than most European countries means that pound was up.
Yeah, if anything, the gap is widened, I would suggest. I mean, I'll leave that to you and John Farrow to lecture me on, but to me, the gap is widened between UK and EU on what we've seen there. I'd also notice you talked to Matt Miller about Bitcoin, and there it is, not quite a 50,000 print yet, but again, it's that risk-on feel. Oil, obviously, off of what's going on in the weather in the Mid-Atlantic. And don't forget, Francine, we've got the markets moving as well. We'll talk to Alan Ruskin of Deutsche Bank, really synthesize in here all that's going on to reset into the end of the first quarter of 2021. Really looking forward to talking to Mr. Ruskin.
Tom, I also had a good conversation, actually, with Jean-Claude Trichet, the former ECB president.
What did he say?
And it's interesting because I was asking him about inflation, right? Remember, under his watch, inflation went from 0.6 to 4%. And he actually wanted to talk about the markets. Tom, he stopped me in my tracks and said, you know what? The problem is that the markets need a correction because they're just not following the real economy. And so you look at the reflation trade and you kind of wonder where it ends up.
Well, you know, maybe follow the real economy. Sounds like an economist talking. What it is a life of its own right now. And it resets always, Francine, around earnings. And clearly that's been the surprise in the first part of this first quarter. We've got ourselves an earnings surprise, a revenue surprise across all the different sectors as well. We'll talk on the politics of the moment with Gideon Rose. Francine, you and I have done this so many times. Gideon Rose really looking forward with Foreign Affairs magazine, The Nation. And then we're going to go to Texas, and what's so important, Francine, is Jim Wright is the real deal. He's not only the most powerful guy in Texas with the Railroad Commission, but this guy knows cattle and this guy knows horses viscerally. He's a legit bull rider and rodeo rider. And let me tell you, in this storm from the Dakotas on down to Texas, it is about the agricultural backbone of the nation struggling.
Right, it is. But vaccines, Tom, I think that, you know, the problem is that we forget we're in the middle of a vaccination process. And so if you don't have the refrigerators because you don't have generators in hospitals to actually be able to, you know, the vaccination is extremely crucial. Now we'll look at what else we're watching as a trading day unfolds. Matt, what's on your radar?
One of the things I'm watching is the cold front moving down over North America, because you've got all the refineries there, you've got all the onshore oil platforms, the wells there, and then it's moving almost to the Gulf of Mexico. If you type map go, you can see this in your terminal, and you can click on the individual energy sources. So as this cold front just moves down, it's covering almost the entire U.S. now with temperatures of 32 Fahrenheit or 0 Celsius. And I think it's going to be incredible to watch this go through tomorrow as well. Fran?
Yeah, Matt, what I'm watching, of course, is this rare earth story. I really like it. I read it in the FT. That was the first thing, actually, I did after going through the Bloomberg terminal and our website. And the rare earth story is really pretty big because it could be the first trade war, or at least China actually escalating because of this rare earth story. The trade war between the U.S. and China will be very interesting to see how Biden responds if they go after rare earths that are really, really essential in some of these defense, of course, the defense industry. Kaylee, what are you watching?
I'm looking at the fundamentals, Francine and Matt. We have a couple of big earnings reports coming up before the bell. CVS is one of them. The stock has seen its best start to a year since all the way back in 2005. So whether or not there's just too much good news priced in, is it possible for any kind of upside surprise given the rally it has already seen in the first month and a half or so of this year? And in that same vein, Palantir also will be reporting this morning. This stock has quadrupled since its direct listing just 7 months ago. And it's not just earnings that it has today. The lockup also expires on Wednesday. So a bunch of big catalysts could be coming for that stock, and we'll see how that shakes out in just a couple of hours, Francine.
Yeah, thank you so much. Coming up on the program a little bit later, Alan Ruskin, Deutsche Bank Chief International Strategist. Matt, when you look at the reflation trade, I know you're very focused on Bitcoin. If you look at the reflation trade, look, global stocks are in the midst of the longest run of gains in 17 years. Now, it's all about optimism about the economic recovery, but then you look at vaccine rollouts, especially in Germany and Europe, and it makes you question what happens next.
Yeah, absolutely. I think one of the most interesting comparisons you can do recently is look at the vaccine rollout in the U.S. and the vaccine rollout in the U.K. versus what we're seeing here in Europe. It's going to be months away for you to get your shot here in Europe, even if you're 70, 80 years old, whereas the UK is finished with that cohort, and the US must be well on its way to 1.5, 2 million shots a day. So it's interesting to see different kinds of systems flex their strengths, really, because the EU's strength is not a quick and easy solution to a big and complicated bureaucracy.
Yeah, it's definitely still a problem here in the U.S. Even at that 1.5 million shots per day rate, it still could take until November until 75% of the country is vaccinated. So herd immunity is a long way away.
November, if only.
If only.
We dream of November, Kaylee. Right? November's a dream for us.
Feels like a long time away, doesn't it, Francine?
Yeah, we also have some European data that actually was better than expected. And again, that goes to the reflation trade that I know we'll continue a conversation on tomorrow. Well, that was fun. We'll do it again tomorrow. And coming up, more Bloomberg surveillance, this time simulcast with Lisa, Tom, and John. This is Bloomberg.
women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Now, in the end of 2022, we could see the strongest GDP growth in over 50 years in the United States.
The economy could bounce back much faster than people anticipate.
We are just flooding the economy with both monetary and fiscal stimulus.
The point is to unleash consumption.
The hope is that we see this unleashed pent-up demand lift us even higher.
That April timeframe is perhaps when we will finally get that pullback a lot of people have been looking for.
The fact that money's going to get more expensive is a good thing. This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Tom Keene, a deepening energy crisis in the United States of America. And this equity market continued to break out, even as Treasury yields grind higher.
Well, I know, John, we're going to talk about the markets across 3 hours here to really reset for the back half of the first quarter. But Lisa Abramowitz, you have lived this, the span from North Dakota down to Texas. And Lisa, this is about the distances, the loneliness out there. It's not like an East Coast storm, is it?
No, people drive very far. But John Farrow, since you haven't necessarily experienced negative 30-degree weather, it is a different kind of cold where your car dies and you need to use pencils rather than pens because the ink freezes.
Don't challenge me on the weather. I'm used to the damp in the UK.
Ooh,
and that goes right through the bones. Right through the bones. Right through the bones. Let's get to this market, guys. Equity markets all-time highs at a close on Friday. And that theme, Tom, continues. Your 10-year Treasury yield approaching 125. And that's the interesting dynamic of waking up this morning, that we can have this breakout in yields and still get an equity market that drifts higher.
This is a shift, and we've got a great set of guests to go into this on a simulcast. John, to sum it up for me is, as you say, we've got higher yields, but the real yield comes in with a vengeance. We have a much lower negative yield on the real yield, and that shows that inflation dynamic versus what nominal yields are doing.
39.50 on the S&P 500, euro dollar 121.66, and Lisa, there it is. Yields up 3 basis points on a 10-year, 124.
Yeah, my question is, how long can we continue this dynamic? At what point are we dealing with a controlled rise in yields? And at what point does it stymie the rally, as you're talking about? And are we pricing in an exit strategy as the economy does recover? We were going to be getting some data today. Not a lot ahead of the retail sales tomorrow, but 8:30 a.m. we're going to get the first read on manufacturing in February. This does not necessarily show what we're expecting, but right now we are looking looking to a big increase in manufacturing. Still suppressed, though, a read on the economy. Also today, hedge funds have to report their fourth quarter investments. These are the 13F filings. The reason why I find this so interesting is it raises a question. How do you generate alpha in an era dominated by central bank stimulus? Are they just going to go into the FANG names? How are they going to differentiate themselves? And when they do, are they going to end up in another GameStop type situation? And of course, today we get a ton of Fed speak. We get Michelle Bowman, we get Esther George, we get Robert Kaplan, and we get Mary Daly, all speaking. The key questions, again, exit strategy. When does inflation become a concern? And at what point will they consider even tapering the purchases that they're doing every month of bonds, John?
Chairman Powell right now does not want to have that conversation. Did you see the headline that came from Bank of America in their latest fund manager survey? Tom, let me read you the top line. Here's the bottom line from them. The only reason to be bearish is ... There is no reason to be bearish. That is the takeaway at the top line of the Bank of America Fund Manager Survey out about 30 minutes ago.
The most talked about news article this morning is Smilak and Tankersley in the New York Times talking about overheating fears have just gone away. John, you were giving me grief 10 days ago. You scarred me out on Twitter as I was talking about S&P 500 4,000.
Well, we're there.
We're there. We're now on the watch for it.
Tom, we talked about some of the strategists that had those year-end forecasts, the 3,800, 3,850. Chris Harvey, good friend of this program, 3,850 year-end over at Wells. Tom, 3-4 months ago, I keep stressing this, that was bullish 3-4 months ago. And now, 3 months later, it feels relatively bearish considering where this market's going.
I want to get this in, John, and I think it helps you with our first guess. I look at the Swiss 20-year yield as sort of a keel of the boat of Europe. John, it's about ready to move to a positive statistic once more. It's been a negative 20-year yield in Switzerland, and it's come up like a moonshot. I know Alan knows this well.
I would go to Bunds as well, Tom. Bund yields moving with Treasury yields as well. Let's bring in Alan Ruskin, Deutsche Bank Chief International Strategist. Alan, let's just start right there, that line. The bottom line, the only reason to be bearish is there is no reason to be bearish. What's your takeaway, Alan?
Well, I think the main cautionary note to the bullish equity view is really that there's good reasons to be bearish in terms of bonds. I think the fixed income story revolves around the reflation that we're going on, but also the risks are very much tilted towards excess reflation. And I'm not necessarily saying we're talking about inflation per se, because inflation is very much a lagging indicator, lags growth by about 18 months. But in terms of growth and the potential for overheating from fiscal policy, which is flat on into if we get anything close to the 1.9 trillion from Biden, money supply growth, which is the highest ever, financial conditions are as easy as we've ever had. There's something for everybody, I think, in terms of reflation.
You know, I look, Alan, at this move that we've had and the idea that we've given up worried about inflation moving up. We have been wrong. I mean, you've been doing this for 4, 5, 6 decades. Alan, I mean, we have been wrong on inflation moving higher. Why won't we be wrong again?
We might be wrong again, and you know, it's a tough call. I think we know where all the risks currently lie. As I mentioned earlier, you know, the lags are long, so we won't know whether we're right or wrong for a long period of time. But, you know, when we think in terms of the things that are disinflationary, part of it just relates to the calculation. The cyclical elements will be inflationary, but we have lots of things which are not cyclical. Things like medical care, things like education. A lot of the services don't necessarily respond to higher growth. So we might not see it in the statistics, but the cyclical elements will almost certainly show some uptick.
Alan, is the reflationary trade dependent on central banks remaining this accommodative forever?
I don't think so. Look, I think the Fed clearly doesn't want to take away the punch bowl in terms of their flexible average inflation targeting regime. You know, if they're true to that, they're not going to be hiking rates for this year. They're not going to be hiking rates next year, probably only hike in 2023. So, you know, I think in that sense, there's not a huge amount of risks. I think the bigger issue is what the market does and what the bond market does. So the market is going to tighten for the Fed to some extent. And I think that's going to constrain some of the bullions that we're seeing in risky assets.
Well, Alan, let's talk about the energy story as well, because crude's been absolutely flying even before this deepening energy crisis in the United States of America. I've heard a lot of people in the last couple of months talking about at the start of another commodity super cycle. Alan, does that resonate with you?
I don't know about a super cycle, but I like oil, and our oil guys, are clearly behind that call in terms of, favorable oil trades. The good news there is that unlike a lot of other markets which are being preemptive, are thinking forward, and it can price things forward aggressively, at least the storage costs in oil tend to mean that you don't price quite far ahead. And I think that helps one in terms of thinking that oil can go higher in the future. And that's what's interesting, I think, is if you look at the curve today, the backwardation we see in the forwards curve is quite extraordinary. So, I think that also hints that you can sort of pick up, I think, WTI around 55. That still seems like a decent bet.
Alan, you do such good work on the history at all times. What is this like? Is there a compare and contrast to a previous moment or time that you can grab on here?
Honestly, Tom, you mentioned 4 or 5 decades, not quite 5 or 6 decades, I think, but closer to 4 decades of work, and I've never seen anything like this at all in terms of, the ease of policy. I mentioned earlier, the fiscal stimulus outside wartime, extraordinary. Money supply growth like we've never seen before. Every indicator within financial conditions, equities, credit spreads, the exchange rate, all are extraordinarily easy. Now, we have come off a particular shock, one of the, really the sharpest shock I've ever seen in terms of the virus. But equally, when we get the vaccine, we should be rebounding in the other direction. So you've got policy compounding that rebound. So, we really haven't seen anything like this before. And we probably are going to see GDP growth rates, our baseline without the 1.9 trillion Biden fiscal stimulus, just maybe something like a 1 trillion fiscal package, is 6% plus GDP growth. We're looking at a 8% type number if we get the full fiscal package that Biden is promising.
Alan, this is exactly why what you're talking about, to tie this all together, this is exactly why people are saying that the old models of what a bubble is, of what overheated is, don't count, because this is a new era of central bank stimulus. It is a new era of reflation with respect to fiscal stimulus. Do you agree? Do the old models not work anymore? We can't count on them to ring the alarm bells saying there is too much froth in the system?
Well, I think we struggle to come up with accurate pricing and appropriate frameworks when interest rates are zero. But as interest rates normalize, and if they normalize at the back end of the curve, then I think we'll start to reevaluate in terms of, what appropriate P ratios are for a given bond yield. And I think that will lead to, some rethinking in terms of fair valuations. But absolutely, if policy is this easy, we don't really know, how to appropriately value things. And we're making a bet and making considerations that relate to whether we will see inflation 18 months hence or not, really. That, to me, is the macro question of the day.
Alan, great to catch up, sir. Alan Ruskin at Deutsche Bank, thank you. Tom, do you know what's amazing? That we're having these conversations before the economy's even reopened. This is what we're talking about right now, stretch valuations moving too far, too quickly. You see what's happened to small caps already this year. I think we're up about 15% year to date.
Well, yeah,
the middle of February.
Not only year to date, but I'd take it back to November 6th-ish, and everybody can argue about which day there, but maybe when we thought that Biden would be elected. And the basic idea is a post-election boom, up 35, up 40% in some of the depressed sectors as well. John, what's so important about what I see, and I think Lisa mentioned this earlier, the idea that we are doing this with yields higher, that happens, it's rare, and again, where is the tip point where yields all of a sudden impinge on the equity markets? I don't see that.
Well, Lisa, apparently it's not 120, and apparently it's not 125.
No, a lot of people will say it's the pace of increase also. People believe it is controlled, and at a certain point the Fed will step in, or there will be natural demand, and that seems to be keeping things in check, John.
We need to get to this deepening energy crisis in the United States of America. Coming up in the 8 o'clock hour, Texas Railroad Commissioner Jim Wright will be joining us from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Equity futures up 16 points. We advance 0.4% this Monday morning, Tuesday rather. Long weekend in the United States.
John, you killed that.
Good morning. morning. Thanks, Tom.
President's
Thanks
Day.
for the support.
Lincoln,
Thanks for the
It
support.
feels like a Monday, John. I got you back.
It's great to be back with you, Tom.
February 22.
This is awesome. I have to do an extra hour of this now. There's 2 more after this one. Okay, this is Bloomberg.
With the First Word News, I'm Karina Mitchell. An energy crisis has crippled the Texas power system, leaving 5 million people across the U.S. in the dark. Homes and businesses from the Dakotas to the Southwest have lost power in the midst of an unprecedented deep freeze. Grid managers can't say exactly when the blackouts will end. The cold blast is just the latest in a chain of extreme weather that has brought down power grids and upended energy markets globally. Meanwhile, House Speaker Nancy Pelosi wants to keep up the pressure over the attack on the Capitol now that Donald Trump's impeachment trial is over. She says Congress must create a September 11th type commission to investigate the assault. A number of Republican lawmakers have said they'd support an investigation. Meanwhile, Chancellor Angela Merkel wants to make a deal with the U.S. over that controversial Russian pipeline that will bring natural gas to Germany. It's been a particular source of transatlantic friction. Construction was halted for a year after the U.S. imposed sanctions. Merkel's coalition is working on a plan that would attempt to soften Russia's influence over Europe's energy market. And yet another record for Bitcoin. The world's largest cryptocurrency rose today, closing in on the 50,000 level. Bitcoin has risen fivefold over the past year. Still, there are warnings that investors could be left with big losses since cryptocurrencies remain highly speculative. Global news, 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment. The politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
In that Senate today was a cowardly group of Republicans who apparently have no options because they were afraid to defend their job, respect the institution in which they serve.
House Speaker Nancy Pelosi talking over the weekend as the president's impeachment trial goes exactly the way many people thought President Donald Trump's second impeachment trial would go. From New York City this morning, good morning to you all. Alongside Tom Keene and Lisa Bravitz, I'm Jonathan Ferro. The price action is Tuesday, shaping up as follows. Your equity market adding some weight to the S&P 500, 39.50, there and thereabouts, up another 0.4%. Treasury yields breaking out, a gap higher at the open overnight, up 4 basis points on a 10-year. Tom Keene, 124.51, approaching 1.25%.
Yeah, rounded up to 125 in the 10-year yield, the attendant curve steepening there, and critically here, the real yield has come in. It is a lesser negative yield. That's a big shift from what we saw before President's Day. John, that is Lincoln and Washington.
Thanks, Tom.
February 12th, February 22nd, and we do it on a, Friday, Monday kind of thing, just to keep people happy.
Well, that's why I came in this Tuesday, just to get the education. Thank you.
The education. We're going to go to Fargo and on down to Texas here with a serious storm in a moment. Right now, Kevin Cirilli joining us, our chief Washington correspondent on radio, on television. Look for him on radio, Sound On. Really quite a good conversation to start the busy evening in Washington. Kevin, this evening in Washington will be about the when of it. When do we get 1.x trillion of stimulus? When exactly is the when?
Well, now that the impeachment's done, I think all of the focus in terms of Republicans and Democrats is going to continue forward with getting that stimulus sometime within the next 3 weeks, I'm told, from bullish estimates from Democrats up on Capitol Hill. The committee work in the House of Representatives has already begun moving through the process of allocating the procedure for the stimulus. The Senate largely is going to skip some of that because they just want to expedite the process. But, look, it's still 3 to 4 weeks away.
Okay, so why 3 to 4 weeks? I mean, I don't understand why Democratic President, Democratic House, Democratic Senate can't help small business, can't help states and locals that are beleaguered, both Republican and Democrat. What's the now of it? Why not now?
Candidly, if this were not, if they were going through the standard procedure, it would take anywhere from 5 to 6 months. And so the 3 to 6 weeks estimate is still remarkably efficient because of the procedural bypasses and U-turns that they've made. In President Biden choosing not to negotiate with Republicans in the Senate and in the House, he has been able to really jump through a lot of time. So I got to be candid here. No matter which way you look at this, the fact that they're not going a bipartisan route in Congress, the administration would say they've met with Republicans at the governor and city level, then that they've been able to go at a faster pace.
Facing another crisis now, Kevin, what's the response of the administration to what's developing across the country on the energy front at the moment?
Well, look, I mean, you look at Texas, for example, where they've declared a state of emergency, a federal state of emergency, but it comes on the heels, Jonathan, where 4 House Democrats have urged President Biden and the Energy Department to rescind the order for there to be no more leases with regards to energy on federal land. They said that right now, given the coronavirus, given all the developments in Texas, that they just cannot simply go through that type of process. And so Texas is hurting, and now at least 4 centrist Democrats are saying, hey, look, this Green New Deal stuff, now is not the time for it.
Well, there's a larger question here, Kevin, and you touched on it with respect to these ongoing outages as a result of extreme weather. This isn't the first time we've experienced it in the past year, 2 years, and it's not going to be the last. How much does this sort of give oomph, if you want to say, that's the CFA term that Tom and I were talking about earlier, give some emphasis to the infrastructure plans that Biden was talking about, or how much does this basically just distract and create another crisis to deal with right now and take away from the longer term outlook?
Lisa, for Democrats, I think it gives a lot of oomph.
Thank you.
I really do. And so, but I think it also, it candidly really illustrates the divide in energy policy amongst Democrats. And again, for 4 congressional centrist Democrats to come out and say, please stop with this new energy policy stuff in your first 100 days, we're getting pummeled in Texas, is really where I think the Senator Joe Manchins of the world are going to pick up on. I go back to what I reported last week when I spoke to a senior aide in Manchin's office, and he said, this aide told me that the senator said, essentially writing that letter, stop with the energy policies at the tail end of the pandemic. Now is not the time. And so that, candidly, is more of a divide that I think is going to get some traction because it's in the Democratic Party in the short term than it is for trying to spend more money after a $1.9 trillion stimulus deal on infrastructure.
Kevin, great to catch up, sir. Kevin Cirilli, Chief Washington Correspondent and host of Sound On Bloomberg Radio weekdays at 5 p.m. 2 plugs
in one block?
Eastern.
That's too much.
I know.
It's just too much.
Lisa, let's turn to the question you raised. I think it's really important. Infrastructure investment. Maybe 10, 20 years ago, the idea of making the investment to deal with the cold snap that's embracing Texas right now might have sounded quite insane. You're dealing with some tail risk. Why make that investment? It is a tail risk.
Is it?
Now some people will ask the question, is it? Will these kind of things occur with more frequency, and therefore do you need to make the kind of investments in infrastructure to deal with these situations a whole lot better?
And isn't now the exact time to do it, given the fact that we have an unemployment rate as high as it is, and you want to generate some sort of job creation? I mean, that's the argument. My question is, how much energy are Democrats going to take away from that, trying to push through a bigger than some want kind of stimulus plan now to fill the productivity gap ahead of getting to that infrastructure plan?
So this is exactly the question, Tom, that former Secretary Summers raised in that Washington Post op-ed 2 Fridays ago. Have you sucked all the oxygen out of the room with a $1.9 trillion spending plan that does not address infrastructure spending? And when you come around to doing it, will there be the appetite to actually do it, to spend more money?
Right. Well, I mean, there's a romance of that. And the Summers article really has resonated rather over the last couple weeks. What I suggest, John, is there's a romance to I-29 down to I-35. Lisa, when she was in Fargo, used to road trip down to Kansas City like it was nothing for a weekend. That's all fine and well, John, but this is about boring, unsexy grids of electricity, much of it's state regulated, which is not something Washington can really do. John, what do you think? I mean, it is the terminal center. The terminal, folks, is what we call the Bloomberg terminal worldwide. And this is like middle Pharaoh, I would call this design.
I think they made a great decision separating us both. I think that was genius.
It's hermetically sealed.
Just keep the glassed wall between us.
I love the terminal
Who's in the zoo, guys? Which one of us?
I think it's pretty clear who's in the zoo.
Or maybe it's both.
I think there's only one animal around here, and it's not me. It is not me.
I will say I-29 is an interesting discussion, not to completely go off the rails here, but it does raise a question right now, Tom. What we're seeing across the nation, the idea of negative 30-degree weather. Ugh.
Well, yeah, it's crushing weather. And, folks, this goes back to the blizzard of 1880, and I think it was 1949, Lisa, where there's a real fear out there.